All right. Hello, everybody. Welcome to the FOMC meeting stream. This will transition us into the market close, which will happen in about 2 hours. In 5-6 minutes, we're going to hear Jerome Powell say what he has to say. The news, headline news, we had two pieces of headline news today. Number one, Robin right here at 2417. Number one is that CPI came in at 3.3%, down from expectations of 3.4%, which is what every bank expected CPI to come in. So we came in just slightly lower, which was really good for equities. 10-year fell. Markets felt that interest rates are going to get cut, which is what we're going to hear about from the Fed. And then the second biggest headline today is that Jerome Powell just came out and the Fed 20 minutes ago. And they said that they are not cutting or raising rates. They are leaving rates stable. They are once again pausing rates. This is the 11th month in a row that we have paused rates. The last hike was in July of 2023. So Jerome Powell and the Fed have decided to continue to pause interest rates. Now, having said that, there's two headlines underneath the two macro headlines, the first one being CPI 3.3 and the second one being another rate pause, that are important to understand. The first one is that the Fed is expecting only one cut this year versus 3 cuts this year. So let me pull up the chart. The Fed is expecting one cut in 2024 versus 3 cuts, which is what they said at the beginning of 2024 and really last FOMC meeting, right? Because they reiterated every single time. So the last FOMC meeting in I believe it was April, they said, hey, we expect, or it was May, they expect we get 3 cuts. Now they said 1 cut. So as you can see right here in 2024, you can see the federal funds rate is 5.1, which would be 1 cut down. The March projection was at 4.6. So that was 3 cuts down from 5.5 to 4.6. Now they're expecting 1 cut from 5.5 to 5.1. However, the reason that, which is bearish, right? Why is that bearish? As Freshly D says right here, is 1 cut bad? Yeah, 1 cut is theoretically bad because the market is pricing in 2 cuts. So not 3 cuts, 2 cuts. So the Fed didn't have to say they were going to do 3 cuts, but the Fed definitely couldn't say they're doing 1 cut because then the market's like, well, are we pricing in an extra cut a little too early? And that's not a good thing. Now, you would expect the market to tank on that. And the market did have a red candle. I'm pretty sure everyone, if you saw your stocks, the market did go red as soon as this came out because it was only 1 cut priced in. But if you look at 2025, the Fed is expecting 4.1, as you can see right there for the federal funds rate, which means that the Fed is expecting 4 rate cuts of 25 basis points each, so about 1% down in 2025, even if they only expect 1 rate cut in 2024. So I think the overall projections going into 2025 is signaling that inflation is coming down, and that if inflation is coming down, it's kind of just a matter of time when the rate cuts happen. And these are just projections, right? If unemployment ticks up, if the economy starts slowing down, the Fed will dramatically decrease rates. They have all the jurisdiction in the world to do whatever they want with raising or decreasing rates. So it's not like these are set in stone, but these are the projections that the market is looking at. And so if we now think instead of 3 cuts or 2 cuts in 2025, we're doing 4 cuts, even if we're only doing 1 cut in 2024, it kind of becomes a wash. Another thing that's really important to understand right here is that the Fed, what was I going to say? Is that the Fed, this survey that the Fed put out today was done before the CPI report. And we've seen this happen pretty much every single time that we have a CPI report. And usually the CPI happens before the FOMC. Today it happened on the day of the FOMC. So the FOMC notes that we just looked at, those come out, like they put those in, I think, a couple days in advance. The CPI came in today. So what I expect to happen is in 2 minutes when Jerome Powell starts speaking, he is going to basically walk down some of the things that we heard in this FOMC note, because CPI came in lower than expected. In fact, all the banks thought it was coming in at 3.4. They were kind of on the same conservative edge with Jerome Powell, thinking that, okay, we're only going to get 1 cut if CPI is going to take a long time to come down. But energy collapsed in the month of May. Shelter went up. If shelter collapses, then we're really going to see some disinflation in CPI. And so I think Jerome Powell is going to be like, well, based on the CPI data we got today, yeah, we think we're data dependent. We think inflation's still coming down. And yes, we only said 1 rate cut, but if inflation does come down significantly, given the data that we are dependent on, we could have more cuts. And as soon as he says that, I think the market basically is like, well, yeah, that's fine. And it kind of makes sense right now because The market doesn't care. I mean, dude, you do not have to wake me up when September ends to tell me if today's a green day or not. Okay, like it's a green day. 542.68 on the S&P 500, 1.07% on the day. Robinhood 2414 up 4% on the day, 3.94%. Snowflake 131, Palantir 2396. We were at 24 for a little bit now, just at 2396. Nvidia 125. Apple is doing well. I mean, it's a pretty green day. Apple 218, wow, up 5.6%. The markets kind of just don't care about what the Fed said right now because they know that if inflation is coming down, then it's not going to be a bad news. It's going to be good news ultimately for the Fed. All right, let me get to JPOW. He's not live yet. I'm pulling that up, and we're going to see what he has to say. Astrikis says, "When did you plan to say that?" Maybe 20 minutes ago when I was taking a walk and I thought of that Green Day bar. Maybe that's when I planned to say that. Maybe that's when it happened. I wouldn't admit that, even though I already admit that, but maybe that's when it happened. All right, so the problem with these streams is sometimes the audio sucks. So I'm going to pull up a couple of different streams. And if the audio sucks on this one, then we're just going to switch immediately to a different one. And we'll see if we have good audio. I think Yahoo Finance is the best audio. We'll start with Yahoo Audio. All right, so we're seeing what JPOW's going to say. We're seeing what JPOW's going to say. Again, 1 cut instead of 3, but 4 cuts in 2024. And that's what we're going to need to see how the markets react. Here's JPOW.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%. But is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance. The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right, time for questions. Here we go.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Just wondering if you could walk me through the committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. it's already 2.75. And after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Yeah. So what's going on there is that we had very low readings in the second half of last year, June through December, really. And we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Yeah, no, I mean, I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis. And that's the test we've applied. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
Yes. That's good stuff by JPOW.
Nick Temeros of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings like the one that we saw this morning make a September interest rate cut possible?
It's a big question.
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between two of these. They're so close for me. These are very close calls. But we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible, but I'd look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly more good inflation readings will help with that. I'm not going to be specific about how many, because really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident? Have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? which is another thing that could happen. But again, we don't see that, and we see today's report as progress and as building confidence, but we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers today?
So this happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't, most people don't. And I'm not going to get into the specifics, but you have the ability to do that so that what's in the SEP actually does reflect the data that we got today, to the extent you can, reflect it in one day. I think we'll see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its, kind of first level translation to PCE, we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So by so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing, mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit, and that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand. And that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago, or even 1 year ago.
Thanks, Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year. And as I mentioned earlier in the, what did we take away from this? We had really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter. And what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year, take place next year. You know, there are fewer rate cuts in the median this year, but there's one more next year. So if you look at year end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. You know, we're at the economy has, you know, repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. You know, how should we interpret what that means about how the committee views its current policy setting?
So two things about that. One is this. You're right, it did move up, but I want to remember to point out that long run neutral rate of interest is a long run concept. It really is a theoretical concept, can't be directly observed. And what it is the interest rate that would hold the economy at equilibrium, maximum employment and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today, we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's, I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were, you know, very low by recent history measures. Now we can't really know that. That's an interesting dispute and discussion to have now. But ultimately, we think that things like the neutral rate are driven by longer run, slow moving forces. And you know, there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And you know, my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having, you know, the effects that we would hope for.
Well, thanks, Chair Powell. Howard Stein with Reuters. Just to carry that a little further, should we read this as a conclusion that the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
I'd be reluctant to try to draw that conclusion. I think this is about, you know, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You know, you can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal. And then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking, and that's why we've been at this policy right now for almost a year.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock on the labor side, and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that though. We're look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Michael McKee from Bloomberg Radio and Television. The base case of the committee seems to be that there is going to be at least one rate cut this year, but your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. But so that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation with growth at a good level and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we were watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market while we're continuing to make progress on inflation. So we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. Ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having a risk management plans in place. So the banking system, seems to be in good shape.
That's not the answer the politicians wanted on rates and housing.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more
So
about
I think it's true that that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages. Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and we've taken some signal from that. But and of course, housing services, you're continuing to see high readings there. To some extent, that's catch up inflation from earlier pressures. But I mean, overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal, cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts could be expected this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy? What you think would be a meaningful difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. Really the whole rate path matters. And I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully, and we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We you always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. So, but we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably on 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction. But one reading isn't. It's only one reading. You don't want to be too motivated by any single data point.
Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
I don't think anyone knows, has a definitive answer why people are not as happy about the economy as they might be. And we don't tell people how they should think or feel about the economy. That's not our job. People experience what they experience. All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had, a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of a long period of high inflation. It is people who, lower income people at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
As just a quick follow-up here, you've indicated one interest rate cut sometime this year, and I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive. For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Well, I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there for a long time, and our goal is to get back to that place. And we've made good progress, and we're in the phase now of just sticking with it until we get it done.
Claire Jones, Financial Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release, what have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, particularly the second half of last year, and we continue to see still strong growth, solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that, and that's not what happened. Instead, the U.S. is anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there were renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents that has to get worked off, and that may take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It just is going to happen more slowly than we thought. we also do sort of this thing where we impute a rental value to owned homes, and that's, many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing, anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Edward Lawrence with Fox Business. Thank you for taking the question, Chair Powell. So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle. What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is basically spending was going up faster than disposable income during big parts of last year rather. And so what that you'd expect to see is people spending more on their credit cards. That has been happening. Credit card balances have been going up. Credit card defaults have been going up. They're not at high levels. Remember that after the pandemic, people were cooped up. They couldn't spend money. They couldn't go out to spend money. They could spend money from home, but households were in very, very strong, historically strong financial shape. They've now worked off a lot of that. So we're watching that carefully. And what do we see? That's what we see. We see the same data that everybody else sees, but you've still got household sector that's in pretty good shape. But nonetheless, it's not in the kind of shape it was in a year or two ago. And we're carefully watching that.
So how close then are we to that point where the consumer can't continue to spend as they're spending, or companies can't hire like they're hiring?
Consumer spending is still growing. It's not growing at the pace it was growing at a year or so ago, but it's still growing solidly. And by the way, other parts of the economy are picking up. Spending on equipment and intangibles has picked up quite a bit in the wake of all the construction that we saw of new tech plants. So overall, the economy is exhibiting solid growth, and something around 2%, which is a good pace of growth for the U.S. economy. But you're right though. We do see the same thing other people see, which is increasing financial pressures on more lower income people, and the best thing we can do is to foster a very strong jobs economy, which we think we have done. Ultimately, to get inflation under control, because those people experience inflation, very directly, very painfully, and once we get inflation under control, rates can come down, which will also improve things.
Hi, Victoria Guida with Politico. You've mentioned that an unexpected weakening in the labor market would bring rate cuts sooner, and I was just wondering, can you talk a little bit about what that would look like? Is it more of like a quicker pace of people losing jobs? Is it more the level of the unemployment rate if it were to start to go above 4.2 or something like that? How are you thinking about what you're looking for to see the job market unexpectedly weaken?
When I say unexpectedly, the first thing is more than kind of is in our forecast or in common forecasts. So something more than that. But we'll be looking at everything. The labor market, has the ability, has the tendency sometimes to move and to weaken quickly. So waiting for that to happen is not what we're doing. We're watching very carefully. We're looking at the balance of risks. I always point out the balance of risks. So and also the fact that we look at all of the whole situation. So a decision to begin to loosen policy could have several reasons associated with it at a given time. But I would just tell, we monitor all the labor market data, and if we saw troubling weakening more than expected, then that would be something we'd consider responding to. But we look at the broader context of what's going on too.
So something like negative payroll numbers would be.
I'm not going to. I mean, I can think of things that many things would make it on that list, but I don't think I'll utter them here.
Ha 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 ha.
Thank you, Chair Powell. Simon Rabinovich with The Economist. May I ask, you mentioned with the slightly higher PC readings earlier this year that it wasn't 1 or 2 months, but 3 months that tipped you to be a bit more cautious in the rate outlook. Should we take from that it looks like May will be quite good for PC as it was for CPI? Does that imply that kind of 2 more good months would reinstill the confidence that rate cuts could be coming sooner than you currently project?
I don't actually have that kind of mechanical thing in my thinking. I get that, as many good ones as we had bad ones, but no, it's not like that. It's going to be the totality of the data, the labor market data, the growth data. In terms of inflation, you'd want to see real progress that builds your confidence that we are on a path down to 2%. And I don't want to try to give you specific numbers of things because that points to dates, and I just don't think we're not at a point of being able to do that.
Thank you for doing this. I'm Kosuke Takami with Nikkei. I would like to know about the impact of stronger dollar on U.S. economic growth and prices. And I have no doubt that the market should determine the exchange rate, but Japan and some emerging markets are suffering from the strong dollar. So I want to know if it is having a positive impact on U.S. economy in total. Thank you.
So we don't. Actually, it's our finance ministry, the Treasury Department, that has a responsibility for thinking about and if it sees fit, doing things about the level of the dollar. So for us, it's just another financial variable. And you're right, the dollar has exhibited some strength over the course of the last year or so because the U.S. economy is very strong. We don't think of it as benefiting or hurting the U.S. We don't manage the level of the dollar. That's not our job. It's not, and for our economy, what we're trying to foster is maximum employment and price stability. And we feel like we've made good progress on both of those goals over the course of the past year.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you would cut rates before inflation falls to 2%. You're forecasting inflation to end the year at 2.8% on core PCE, or at 2.8%, of course, on core PCE. Right now, you said the inflation forecast is conservative and that if you got 2.6 to 2.7 on PCE, that would be a good place to be. You also indicated the job market has mostly normalized. So why not cut rates this summer just once? You're well above neutral, to try to preserve the soft landing rather than risking waiting too long in the quest for confidence for inflation.
So we're well aware of the two-sided risks here. Let me just say, we understand that if we wait too long, that could come at the cost of economic activity, of employment, of the expansion. We understand that if we move too quickly, we could end up undoing a lot of the good that we've done and have to then start over, and it could be very disruptive. So we're extremely aware of both of those risks and just basically trying to manage them. And what we said is that we don't think it'll be appropriate to begin to loosen policy until we're more confident that inflation is moving down to 2% over time on a sustainable basis. That's kind of been our test. Or there's another test, which is an unexpected deterioration in labor market conditions. So I think that's the right way for us to think about it. That's our dual mandate there, and we have a strong economy. We've got growth. All forecasts are very commonly around 2%. That's a strong growth rate for our economy. The labor market continues to print jobs at a pretty high rate. Unemployment's still low. So we have the ability now to approach this question carefully, and that's what we're doing.
Just to follow Chair Powell, do you need to be ahead of a weakening in the labor market? Otherwise, is it too late, given that the labor market is a lagging indicator, right? When you look at the monthly jobs data.
Yeah, we completely understand that that's the risk, and that's not that's not our plan, is to wait for things to break and then try to fix them. We're trying to balance these two goals in a way that is consistent with our framework, and we think we're doing that.
Thank you, Chair Powell. Evan Reiser with Market News International. You have mentioned before the framework review process will start in the latter half of the year. At this point, do you have any specific time frame for the start of that? Who will lead it? Will it be you or a committee group of your peers? What will be the parameters? Do you anticipate the review will consider changes to communications going forward?
So what we've been thinking is that we would announce and commence the review later or late in the year. In the meantime, as that time approaches, we will be devoting a lot of careful thought and planning to the contours of it. Within scope would certainly be communications generally. I'm not going to say that we'll look at this or that particular thing, and all the other details. We don't want to get prematurely into a conversation until it's really time to have it. And so, I'm going to leave pretty much everything else to later in the year.
Go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just one more question on housing. Can you still cut rates with shelter prices high, or will you wait until they start to moderate a bit?
I wouldn't, there isn't any one variable like housing prices moderating that would really decide against what we're doing. We've got an overall test, which is greater confidence that inflation is moving down to 2% on a sustainable basis. That's our overall test. Or alternatively, we see unexpected weakening in the labor market. So those are two different tests. I would say, we're not looking at any one price in any one sector and saying that's the one. We don't target housing prices, for example, and we don't target wages. We target aggregate prices and overall employment. So,
but if housing prices remain sticky, could that slow down the pace of rate cuts?
I think you'd look at we'd be looking at the aggregate numbers and asking ourselves what's going on here with inflation at the aggregate level. And of course, if any price that contributed to ongoing inflation would matter. Any price that contributed to ongoing disinflation would matter too. But I wouldn't single out housing as having a special role there. Thank you very much.
Okay, there we go. That's JPOW. Guys, let me know if my audio is okay. It should be good. Let me check real quick. Okay, yeah, I think the audio is good. We've got a lot to talk about. Folks. Welcome officially to the market close now that we are done with JPOW. I want to recap what I got from the meeting. Let me know what you guys thought in the comments. And then we're going to look at some of the headlines that we've got going into the close. Tomorrow is going to be a big day. Not only do we have PPI, but we have the Tesla vote happening, I think at like 4:15 or 4:30 or something. So I'll be live for that Tesla vote. I think it's like a live shareholder meeting that has all of that play out. And so we'll be talking and discussing all of that and keep going from there. All right. So, yeah, it's at 4 p.m. So I think I'll be live at 4 p.m. Okay. So, I thought it was a good meeting. And the reason I thought it was a good meeting is because at the end of the day, so if you're just joining, no cuts or pauses this time. It's been 11 months since we had a rate hike. No cuts or hikes. It's been a pause. We haven't had a cut or a hike in 11 months. And the Fed's projections are now 1 cut in 2024. That's what they're pricing in. And 4 cuts in 2025, which is revised from 2 cuts in 2025 and 3 cuts in 2024. Ultimately, the market doesn't the market doesn't care, right? And the reason the market doesn't care is because essentially you can see right here, S&P 500, 542, we were at 543, but here at 542. The market doesn't care because they saw the data we got on CPI today. That is in a downward trend. The only thing that was higher outside of like the stuff that really isn't that important was shelter. And we all know shelter is coming down. Now there's a sort of chicken and the egg game around of shelter only going down if we lower inflation. We'll talk about what JPOW said about that. But in general, if inflation's coming down, the market doesn't believe the Fed about their one cut projection, especially given it's an election year. The market thinks we're getting 2. And if we're getting 4 in 2025 and 2 right now, or maybe 3 in 2025 and 2 right now, that's why you see the markets really not caring. Robinhood, $24.08. Robinhood was at $24.28. You got Palantir that's down. Palantir's down, in my opinion, for other reasons. We'll talk about that. But I think Palantir just has to keep growing into the valuation, and that's why it's down right now. I don't think it's really anything macro-driven. NVIDIA at 125, up 3%. Open Doors up 5%. Micron's up 3%. Apple, we'll talk about them, 218. S&P 500, 542. Microsoft, 441. When's the last time Microsoft had a 2% day? Usually Microsoft doesn't move that much, but Microsoft is moving. Amazon is slightly down on the day, 186. We're going to have Steve join us on the market close in just a little bit, and he'll give us a little bit of his thesis on Amazon, Alibaba, and GameStop. Speaking of GameStop, let's take a look at that. GameStop is down 8%. So JPOW is not good enough to get GameStop pumping. And the NASDAQ QQQ is at 474. That's up 1.34%. So essentially the market is looking at what's happening with JPOW and saying, well, wait a second. JPOW is making an argument that is not necessarily bad. And if he's making an argument that's not necessarily bad, then there you go. There's no reason for us to sell off equities or for us to feel that equities are overpriced. Palantir resistance was at 24.40. It hit that and retreated. That's also another good point. We have massive resistance at that 24.5, 25 level. And we experienced that in the last earnings. We got to like 25.30 and then boom, we came right back down. So there's going to take a lot of buying momentum, just like we needed a crap ton of buying momentum to get over 19.5 back in February, but a good earnings got us that. I think the same will happen maybe in Q2, but we do need that momentum to keep going from there. ARM is up 8%. Yeah, ARM's moving along with NVIDIA. So what is the take here based on what we're seeing from the markets? I think the take here is that JPOW's made a simple argument about the fact that interest rates are coming, or interest rates will inevitably come down when inflation comes down. He kept saying that he's data dependent. All of the questions kept asking the same sort of argument that he kept giving the same answer to, which is like, look, we're looking at the data. Now, to me, it wasn't a hawkish, hey, we're looking at the data. It's more so, yeah, we're looking at the data. And once we get the right data, we're going to be able to make the right decisions. But we're going to need to see the data in a meaningful capacity for us to ultimately lower rates. And I think the market does believe JPOW will do that. Now, that begs the question, and I saw a lot of comments said here in the chat, so let's talk about that. Is this a top? Is this time to sell? Is this time to take some profits? Is this time to buy puts? A lot of these comments, I'm not only seeing in the chat, but seeing on Twitter. Look, I don't think anyone can call the top. I don't think anyone can reasonably say, yes, this is the time where you trim and you take profits and all that stuff. I mean, a lot of people were saying that at 510, at 520, definitely at 530, now at 540. It's hard to imagine that the trend is not towards the upside, especially with inflation coming down. However, I think that if you want to take profits, it's not the hardest decision in the world. If you're sitting on a ton of money, let's say the S&P gets up to like 5,700, 6,000 towards the end of the year, you're going to miss out on some gains, but it's not like you sold at 480, right? It's not like you missed out on the rally. In fact, there was a note by JP Morgan today that clients are pummeling into the market because they're afraid of missing the next leg of the rally. So that would be my argument for taking profits, is like, hey, if you made some money, take some profits. It's not that big of a deal given we've had, 14% up in the S&P. My argument for not taking profits and kind of seeing how this plays out is that now the market's really getting interested in money entering into the next leg of the rally, because the first leg of the rally, the people that missed it, are the people that missed it. But once that first leg of the rally solidified a full bull market rally, now you've got $6 trillion on the sidelines. Now you've got people that were listening to Mike Wilson that have been collecting 5% for the past 2 years that are like, this is just ridiculous. There's no reason I don't have NVIDIA. There's no reason I don't have Amazon. And they want to get some money coming into the markets. Here's a good chart by our boy Ryan Detrick of Carson Research. Here's what he put out today. When the S&P 500 was up in November, December, January, and February, the next 12 months have never been lower. This has happened 14 times in history since 1950. And on average, the S&P is up 17.4%. Right now, it's up 14%. So theoretically, if it stays on the average, there's 3% left to go for the rest of the year. And that means that in 2024, given November, December, January, and February were green, the rest of the year could be green. So again, the final 10 months of the year, you're looking at about 14.9%. and 100% probability that it does go higher. Now, these things are not always accurate, but it's one historical way to gouge what could happen in the markets. Here's another chart that I thought was really interesting. The year of the dragon. So the 2024 is the year of the dragon. The S&P 500, 5 times, 1, 2, 3, 4, 5, 4 times out of, 5 times out of 6 times has gone up during the year of the dragon by an average of 8.7%. The only time it didn't was in 2000. So 2024, the year of the dragon, that is potentially another reason for the S&P 500 to match the historical pattern. Again, a lot of this stuff is not, it's not like scientific or anything, but I mean, I guess there is some science to looking at historical patterns, and the market is kind of rooted in historical patterns. And so if the question is, hey, is this a top? Is it time to sell? Maybe it's not, given the S&P historically tends to go up. On top of that, and again, we've been saying this on the Market Open for a very long time, AI earnings are real. I'm going to read one sentence again if people missed it on the Market Open for Oracle from their earnings. They said this one sentence: Oracle signed over 30 AI sales contracts totaling more than $12.5 billion in the last 90 days, including one with OpenAI to train ChatGPT in the Oracle cloud. I don't think in the next 90 days that AI is going to go away. I think Oracle, Microsoft, Palantir, Apple, etc., all these companies, well, we'll talk about Apple in a second. Apple's got to produce upgrade cycles, so we'll discuss Apple in a second. But all these companies that have already produced results, NVIDIA, Amazon, etc., they're going to keep producing results. I don't think in Q2, which is May, April, and June, those 3 months, we're almost done with Q2 in about 20 more days. I don't think those days are going to be bad. I mean, I don't think those months are going to be bad for the market, and definitely not for earnings, which means if earnings continue to expand, multiples will continue to expand, inflation continues to come down. Yeah, that's the argument for why this is not a top and why people will likely buy this dip. Now, could we get some short-term dips in between? 100%. Robinhood was touching 24.20 for the majority of the day, right now at 23.85. These, to me, are incredibly algorithmically driven sort of cycles in terms of how the stock price reacts, especially because if it stays at a certain level, then it just randomly comes down. It tends to find its place back to where it wants to go, especially if there's so much demand for the majority of day, for example, on Robinhood buying shares at $24, or the S&P trying to get shares above 535, 537 into that 540 range. So if the demand is there and the data matches what the market wants to see, which is higher earnings and inflation coming down, then I don't think necessarily this has to be the top of the cycle. It means there might be a lot more room to continue running. Some of you guys called it astrology. I like looking at those charts because, I mean, why does everyone say an election year is always good for the markets? Because historically, an election year has been good for the markets, right? So a lot of times stocks tend to just run based on not fundamentals, but based on how they've historically run in the past. And look, there's a lot of math and logic behind that as well. You could make the argument that during XYZ type of year, there are certain behavioral patterns. I mean, if we take the election year, for example, if we don't know, or if we do know who's going to become a president a couple months into the year or a couple months out of the election, the uncertainty of the Democratic House of Representatives, Senate, and executive branch, or Republican version of that starts to become more certain. And people tend to buy stocks, right? If they know what's going to happen, or at least the market tends to price in that security versus the insecurity in previous years. So there's a lot of different ways you can adjust human and psychological behavior with the historical patterns of a certain subset of the year being green or red. And then it just is a question of if it plays out at the end of the day. People are saying everything's I don't think everything's tanking. The S&P is still up 0.72% for the day. Apple is still up 4%. Microsoft's up 1.74%. Robinhood is still up 2.5%. Yes, it's not up as much as it was up, but I mean, that's just a typical green day. I mean, if things go up and they rip up, yeah, people are going to take profits and algorithms are going to kick in, and you're going to see a little bit of downside. Now, let's talk about Apple. Apple at 216. Here's my question for the chat. Would you go long Apple here, or would you buy puts if you had to? Let's do a poll. It's a tough question. It's a really tough question. It's not an easy question to answer. Would you go long Apple here at 216? It was at 220 a couple minutes ago. Or would you buy puts if you had to pick one? And you've got to pick one. One could argue Apple gaining $250 billion in market cap in 2 days off of doing nothing other than explaining AI emojis. Might not be justified. Another argument could be, well, wait a second. If this is the gateway towards AI, then Apple is incredibly undervalued because 2 billion people are about to access AI and there's going to be a massive upgrade cycle. So I want to know what people think. Apple long or short from here? Long or short? And again, short doesn't mean you're literally shorting it. Short just means you're buying puts and and you're hedging against potential overvaluation with Apple. I'm curious because there's a certain subset of FinTwit that is like, Apple's the best. We knew Apple was going to win forever, and like Apple. And then there's the other subset of FinTwit that says, look, it's not that Apple's not the best. It's just like they're not growing, and like at some level, giving this much market cap to them is a little intense, given they haven't really proved anything outside of buybacks. Andre, who's a friend of the channel, he posted something really interesting about Apple as well. So let me share his tweet. I'll put the timeline is 1 year. The timeline is 1 year. So long Apple for 1 year. Long Apple for 1 year. That's the timeline. Or even 6 months. You can say till the end of 2024. The point is, right now, would you go long or would you short it? So I'm going to put this tweet in the chat. Definitely recommend following him. He's also a fellow Palantir investor. So he said, I sold Apple in January 2022. Since then, Apple grew 24%. So about 9% annually. Kind of what you would expect from the market, right? S&P 9%, which means Apple has been a mediocre investment for a long time. And I mean, it's not the craziest argument, right? Apple is up 24% in the past 2 years, which is kind of what we expect from the market, going up about 9% or about 2.5 years, which means it's not necessarily that different than buying the S&P. And you would think if you're buying Apple, you get a bit more alpha than buying the S&P. Now, granted, Apple is Apple, and Apple has done very well before the past 2 years, right? It's had an incredible run. But the question is, if you got in, 2 years ago, you're kind of not up that much compared to some of the other stocks that are in the market. So I'm really curious how people are. I expected a decent Apple run after the AI event. This is just beyond imagination. I mean, at one point, I think Apple was up 20% year to date after being down 10% year to date for the majority of the year. Now Apple is up how much? Apple's up, 15% year to date? Apple is up 16.7% year to date. What does the poll say? Let's see the poll. Let me open up the poll. Let's see. I'm actually using the iPad because I finally charged it. Wait, did I ask the poll? Did I not ask the poll? Hold on. Where is the poll? Oh, weird. The poll doesn't show on the iPad. This is why I'm shorting Apple. Okay, here we go. So 180 votes. 53% said short. 46% said long. Okay, so it's 50-50. It's 50-50. See, it's a hard question. I expected it to be 50-50. I didn't expect it to be 80-20. It's not an easy question to figure out if Apple, because again, this is the breakdown of Apple. Either the models are BS, right? They're all commodities. They're not that important. And the gateway to access consumers using the models is the thesis around AI. And the market totally doesn't understand it, which is why Apple's undervalued, because Google's not going to introduce the world to AI. It's going to be Apple. Therefore, you buy Apple. Or, I mean, no one really cares about generative AI emojis or asking Siri about some random question or scheduling your meeting, and therefore AI. But it's hard to say that, because that would deny the sort of essence around AI around consumers. And I think AI for consumers is going to be a big deal, even if it's going to be more important in the enterprise. Another point about Apple, what's his name? Tim Cook mentioned in an interview yesterday that all of the Fortune 100s, let me pull up the tweet, have bought the Vision Pro. I thought this was really interesting. I did not, he's never said anything about the Vision Pro for like the past 4 months, including earnings. But he said the top Fortune 100 companies have bought the Vision Pro and are actively using it. Now, that's not enough to make the Vision Pro a mainstream product, but it is interesting that in the enterprise, they're seeing value for the Vision Pro, even if consumers are not seeing value for the Vision Pro either. And so maybe, maybe that's another growth vector for them that could be potentially interesting as well. I'm not going to short Apple. First of all, I don't short any company, but I wouldn't buy puts on Apple either, because again, although do I think that the valuation has gotten up there? I mean, in 2 days to add over $300 billion, is that kind of crazy given they showed zero growth? Yeah, like that's kind of crazy. But at the end of the day, Apple is Apple, dude. And you could be bearish Apple. You could be skeptical of Apple. And I've been very skeptical about the Vision Pro, but I don't think it's something you could ever buy puts or short on rigorously, and the shorts had fun in the beginning of the year. I think they got it from 190 to 165, but I mean, to assume Apple was going to 100 or 130, it's just tough to imagine it goes that low, because at the end of the day, they're still pulling up, almost $500 billion in revenue a year, and they have $100 billion in buyback. So even if Buffett chooses to sell, they have a safety net for him. Now, the question is, does 200 become support? Does 200 become support? Because if 200 turns into support, or 205 turns into support, Apple still has a ton of room to have some momentum off, and it doesn't needs to fall back into below the 200s. It's up 7% year to date. And the market potentially gets more excited when they see a dip to 205. I mean, that's the natural psychology with stocks, right? People are conditioned to buy Palantir now at 21, 22, because right now it's at 23. If it falls $2, you're like, okay, that's a dip. If Apple goes from 218 to 202, that's going to be a dip that people are going to want to buy. And I think that will be excited or be interesting for Apple. Joe says, admit, don't lie. You shorted Snowflake. Well played, though. So I actually didn't short Snowflake. However, speaking of Snowflake, let's actually bring that up real quick because I wanted to show you guys this one thing. So what's his name? Sridhar, the CEO, talked to Jensen Huang about Snowflake yesterday. This is a 2-minute clip that I want to play for you guys. I thought it was really interesting just how this kind of dynamic played out. Let me see if I can pull it up right here. Jensen Huang, Snowflake. Snowflake having a little bit of a recovery today. Obviously, it fell a lot over the past couple of days. But essentially, Jensen was on stage with Sridhar, who's the CEO, and the way they were talking about the AI revolution, I just thought it was interesting. I thought it was really interesting for a variety of reasons. But let me see if I can pull that up, and then we'll keep going from there. Where's SoFi as well? While I'm pulling that up, where's SoFi? Let's see. How did SoFi do today? SoFi, Apple 215, SoFi 707. Okay, so SoFi giving back most of the gains they got today. The fireside chat I thought was really good with Chris Lapointe, the CFO. He said some interesting things about student loans and about their member growth. I mean, let me read you a couple of quotes, actually, and then we'll pull up that Snowflake thing. So Chris Lapointe, CFO of SoFi, he said, Him's also having a decent day. He said, and then I got to give you the short float update. He said SoFi is declining 80% of the applicants for their loans, but has a lending referral business that brings in $50 million annualized. He said more and more people are using SoFi as their primary bank, and 30% of the recently added members are using a second product within 30 days. So the upsell to members is important. On the tech platform, he said dozens of customers at early stages are at the beginning of monetization. He said we're also in discussions with large banks in the US and Latin America for their offerings going forward, and the discussions are going very well. He didn't mention any specific names. And that's kind of the gist of what he mentioned. So he said a lot of good stuff. Now the problem is SoFi's short float went up again. It went up again. So here's the short float for SoFi. It went up to 18.64%, as you see right here. It went up 2.45% over the past 2 weeks. This is as of May 31st. So 18.64. Palantir went down 3.45%. So Palantir only has 3.94% of their shares sold short. People are really scared of the cocaine comments, I think. So they're not messing with Palantir. Only 75 million out of the 2.1 billion. SoFi has unfortunately 183 million out of the 995 million sold short. And so I think what's holding SoFi back is that it's getting really short. And that's been holding it back for the past month now, which has been hit. Chris Lapointe said this at a fireside chat today. Chris Lapointe, the CFO, said this at a fireside chat. Palantir 2369, Robinhood 2365, S&P 500 540. Again, yeah, we have a red candle, yes, but we're still at 540 on the S&P. We're still at 0.74% on the day. So I also think that's kind of healthy, right? We don't need to be at 550 today. Like, we had a good CPI report. JPOW was relatively dovish, even if there were some hawkish things said about inflation. And so you're getting a little bit of a sell-off here. Now, GameStop, I don't know why this is falling 16%. If anyone knows why, please let me know why that's falling 16%. This is why it's hard to own GameStop, man. And look, I said last night on Twitter, I'm very intrigued by the fact that they raised $4 billion, but I could just never buy it or hold it because I have no idea what the company's going to do with the $4 billion. Why is it falling 15% right now? I have no clue. I don't think Roaring Kitty tweeted anything or anything like that. But that's weird. That's a pretty nasty sell-off. I don't think that's because of JPOW. Look at the 20 call volume, huge block sales of 5K hitting. Oh, wow. Is he selling? Hold on. Let's check right now. If the open interest is down, then someone was selling and maybe it's Kitty. So let's go to GameStop options, sell caller, or what is it? June 21st, right? The $20 call. Yesterday there was 152,000 open. Right now there's 169,000 open. So that call, this is the one that Kitty bought. Now, technically, he could have still sold and someone else bought them, right? But the open interest on that has gone up. So it seems like more people are buying that. Open interest only updates overnight. We'll know tomorrow morning. Interesting. Okay. So if MB is correct right here, if there's huge block sales of 5K options hitting that strike over the past hour, that's definitely hurting GameStop stock. Now, having said that, it might not be bearish. Roaring Kitty might be selling that to generate some funds to end up exercising his contracts, right? Because he doesn't have 240 million liquid to buy 12 million shares. So he might be selling some contracts to get the money to be able to buy those shares, which is actually kind of bullish. But I don't know. I guess that might be hurting it. I don't think Kitty's selling either. I agree with Dougie. I think Kitty's holding this thing till it plays out at the end. And I think he has a plan going into the next week. But someone might be selling it, which is why it's getting hit. Apple at 214, S&P 540. Bitcoin did not like what JPOW had to say, unfortunately. Bitcoin down from 69,000. It hit 70,000 this morning. I don't know what it's gonna take to get Bitcoin to get excited. Maybe a rate cut, but it's been teetering for the past 4 months now in this 66 to 70 range. And I don't know what it needs to really get its momentum. Now, one thing JPOW did say on shelter, we talked about this in the morning. Elizabeth Warren sent him a strongly worded letter saying, hey, can you cut rates? Because if you cut rates, that'll help decrease inflation because it will increase mortgage applications. It will decrease the cost of housing, and that will actually help your inflation problem. And JPOW said one sentence. He said, the best thing we can do for shelter and home prices is decrease inflation. So Powell's argument around decreasing inflation has nothing to do with lowering rates to stimulate the housing market, which would potentially decrease inflation. His argument is we need to naturally just decrease inflation, doing whatever they're doing, which is quantitative tightening and more tighter fiscal policy in order to potentially allow inflation to come down, which would then lead them to cut rates. So you do have a conundrum here of the politicians that don't have a crazy argument that says, hey, we need to cut rates so that people can afford houses, which will lead to housing prices to come down. But JPOW does not want to jump the gun here. And if he does, I think he's a little bit scared that it could end up leading to re-accelerating inflation, which is obviously not going to be a good thing for his mandate. David says the longer Bitcoin is in this channel, the greater the breakout will be. I agree. I still think we have a summer pump coming in for Bitcoin starting in July and August. And I guess we're just going to have to see how it plays out. But ultimately, the longer it's in this channel, the fact that it hasn't collapsed below these levels is also exciting because it means that it's actually stayed high. And people, there's a bid willing to end up buying it. Real quick on GameStop, let's do one quick video I want to show you guys based on what Cramer said this morning. I think you guys will get a kick out of it. He's been not the biggest fan of GameStop, but he had some interesting things to say. And then we'll talk more about Elon Musk and OpenAI because there's some new updates on that situation. All right, so here's Cramer on GameStop this morning.
Reddit. I go on Reddit, Wall Street Bets. Today they were featuring the turtle. And I do think that GameStop won here. The Bears are going to be in retreat because now Ryan Cohen, he has total control of the money, has $3 billion to play with. So what I think he would do, he never listens to me at all, or he throws me an ice cream cone or good humor, I don't know. But they now have the money to be able to write a check to any mall in the world. They do have 4,000 stores. They could get out of every lease, close every single GameStop by my take for a couple $1 billion and start over. And that's just unbelievable. So my hat is off to what they did in terms of being able to take advantage of the memesters.
To refresh people, they were doing an at-the-market offering led by Jeffries. They've been selling every day for the company, raising money for the company. This, of course, as Jim pointed out, since the stock rose dramatically. Now, by the way, they did 45 million shares and raised almost $1 billion. Then they did another 75 million, which they've now completed raising, as you just said, about $2.1 billion. So you are talking about Jim, you asked me about Paramount. Is there anything you can remember that's similar to this? A company raising $3 billion? What percent of the market cap of this was this?
Company's is $10 billion. They have $3 billion. They have almost no debt. They have that
so they
piece
raised
of paper
30% of their market value
The big issue was the leases
in cash.
He could right now write checks to whoever he has, Simon Properties, doesn't matter. get out of like he can pick the 3,000 bad GameStops. He could close them. He can then open another company. And this is no longer GameStop. This is SPAC. It's a Ryan Cohen SPAC. And this will be his chance to really demonstrate that he's a great business person and do Chewy too.
It's a great point. In many ways, you're right. It's like it's a blind pool of capital that he has control of now as the CEO of the company.
With no debt.
That was raised thanks to a gentleman named Roaring Kitty.
Right.
Who's
Dude, I think it makes a lot of sense. I mean, basically, he has $4 billion to do whatever the hell he wants, and he doesn't really have to worry about those $4 billion outside of figuring out where to allocate it. So I actually think, again, it's just incredibly interesting to see how GameStop's operating right here. 25.90 down 15%, but Ryan Cohen, $4 billion out of thin air to do whatever you want, whether it's shut down the stores or, really pivot the business, do something different, put the money into Bitcoin. But that money can't really be ignored. And that's why, GameStop potentially does have a chance. If anything, GameStop has potential. And I think at the end of the day, it's like, we're attracted to potential naturally as human beings, and something that has potential. If they mess it up, it's on them, but they have the potential to not mess it up, given they have $4 billion now to do what they need to do. Okay. Now let's talk about Tesla and some of the stuff that happened later let's talk about Tesla and what happened earlier this day. So Adam Jonas from the Jonas Brothers brand put out a post. He was on tour, but he decided to put out a post before he goes traveling and singing his heart out, saying, "Will Tesla do a phone? Yeah, we think so." This was interesting. Okay, so let's read what he says. From our continuing discussions with automotive management teams and industry experts, the car is an extension of the phone. The phone is an extension of the car. The lines between the car and the phone are truly blurring. So his argument is that there is a reasonable way for Tesla to come up with a phone. He then goes on to further say, for years, we have been writing about the potential of Tesla to expand into edge compute domains beyond the car, including last October. As Mr. Musk continues to invest further into his own LLM Gen AI efforts, such as Grok, the potential strategic and user experience overlap becomes more obvious. From an automotive perspective, the topic of supercomputing at both the data center level and at the edge are highly relevant, given the incremental global units sold is a car that can perform OTA updates of firmware that has a battery with stored energy equivalent of approximately 2,000 iPhones and a liquid-cooled inference supercomputer as a standard kit. What if your phone could tap into your vehicle's compute power and battery supply to run AI applications? Edge compute and AI have brought to light some of the challenges of battery life. That's what Enovix is working on. Numerous media reports have discussed OpenAI potentially developing a consumer device. The phone is a heavy car key. Any Tesla owner will tell you that they use their smartphone as their primary key to unlock their car, as well as running other remote applications while they interact with their vehicle. The action button on the iPhone 15 potentially takes this to a different level of convenience. So this to me is pretty stupid. Okay. But nonetheless, Adam Jonas is a very popular singer, and so we have to take his music seriously. His argument is that, look, Tesla will make a phone, and that's going to potentially create a new level of growth for the company because people already use their smartphone as a way to access their car. Now, Elon responds 2 hours ago, "We could, but hopefully it isn't needed. Tesla is one of the few companies that has its own tech stack, not iOS, Android, or forked Android." I don't think a Tesla phone makes any sense. That is my personal opinion. I think everyone who thinks they would love to use a Tesla phone, they're going to end up using their iPhone. I think software is very hard. And if you're not running iOS and you're not running Android, you would have to literally create a new piece of software. And for the past 2 decades, we've been using some version of iOS or Android universally. The Windows phone failed. The Amazon phone failed. The idea that Elon would come up with a phone that would be so much better, I'm very skeptical of that. So it is weird that Adam Jonas put out this report. I mean, it kind of speaks to a little bit of desperation from Morgan Stanley, quite frankly. That's my honest opinion. The idea that he's putting out a note that Tesla's going to make a phone, I don't know. Doesn't make sense to me. It really just doesn't make that much sense to me. Now, Neuralink is totally different. I think there's a lot of other tech innovation Elon's going to be good at, but the phone doesn't make that much sense. Having said that, OpenAI was thinking of coming up with their own phone as well, right? And they were potentially raising money with Johnny Ives, who used to be the head designer at Apple, to come up with an AI-based phone. I think the iPhone beats all of these different hardware devices. But the fact that Elon's potentially thinking of it, which he just confirmed he's not, but people are thinking Tesla could be doing it. Interesting idea. I don't think it's actually something that's necessarily going to go down. Here's the update on Elon dropping the suit against OpenAI, and then we'll keep going from there.
Elon Musk now dropping his lawsuit against OpenAI and its co-founders over breach of contract and fiduciary duty. This one day ahead of the results of his big shareholder vote on this pay package. Our Deirdre Bose is going to break that down for today's Tech Check. Morning, Dee.
Carl, good morning. So this ends a months-long legal battle with OpenAI, the company he co-founded, but it also leaves the door open to refile at another time. You mentioned the timing. It's interesting. Musk hasn't backed off his criticism of OpenAI. In fact, he doubled down this week, threatening to ban Apple devices from his companies after it announced a partnership with the startup, calling the integration an unacceptable security violation. And he is still full steam ahead on his competitor, xAI, having just raised a $6 billion funding round. But dropping the lawsuit just one day ahead of that Tesla shareholder vote on his pay package, or at least the results of it, could be seen as a signal to Tesla's board that he is more focused on that company. Plus, the Journal reports that Musk has joined recent meetings with proxy advisor Glass Lewis and investors alongside Tesla chair Robin Denholm. Now, here's where we stand at the moment. Proxy advisors Glass Lewis and ISS, CalSTRS, among names that are against the pay package. ARK Invest, Baron Capital, Altimeter, they're on the other side voting in favor of it. The vote is expected to come down to individual investors, which have historically backed Musk. And it's a group that Musk himself has been courting through posts on X and incentives like a tour to Chance Tesla's Texas production plant.
Now, speaking of those individual investors, I just realized today my dad is one of those individual investors. So I realized today my dad has 33 shares of Tesla. And so as you can see right here, he has an average of 250. It's not the best average, so he's down like 27%. But I realized I can use his shares to vote for Tesla and to get this. I mean, I don't know if my dad's 33 shares are going to make the biggest difference, but every share counts, right? If it comes down to retail investors, if every share counts, then I'm going to do my best to try to help this man get paid. So those individual investors are going to be the reason I think Elon gets paid. ARK Invest, Brad Gerstner, Ron Barron, they're going to vote for it. But then you've got people like the Norwegian State Pension Fund that has 33 million shares that are voting against it. Somehow they're up 7x on their investment and they don't think he should get paid. It's disgusting. Another thing that's disgusting is Ross Gerber, unfortunately, voting against it as well.
Tesla's made since then, it's been a wildly successful company up until the purchase of Twitter. And so, for me, it's really about the process. This is a corporate governance issue. And the reason the pay package was voted down is because the board of directors of Tesla is an absent board. They're totally negligent. They all work for Elon, and it's not an independent board as required by the exchanges. And so this company is not run correctly by the board of directors. There's nobody to blame for this mess but Elon and the process that you're supposed to go through when you get a compensation package approved by your board. They just didn't do it right. And so now we all have to suffer through this, and the amount of money is outrageous. And on top of the fact that the performance of the company has been horrendous over the last 2 years. So that's why I'm voting no. I just think that they're just creating more problems, and Elon and the board should work on a fair pay package moving forward.
Yeah, well, you cited many of the reasons that Chancellor McCormick and the Delaware Chancery Courts struck it down, saying the board was not independent. But all that said, Ross, I mean, this was something that was agreed to, that 73% of shareholders voted in favor of some 5.5, 6 years ago, and that he delivered on. So, again,
That's right.
I mean, looking back, shouldn't a contract and a promise be a promise?
That is, if it was really a contract between two parties. And that's the whole point, is that wasn't. It's not a contract. It's not a deal. A deal is when two individuals shake hands and negotiate. There was no negotiating process at all. There was nobody representing shareholders. For example, if somebody would have pushed back to Elon and said, how about we do half this number? It would have still been an outrageously good pay package, and it would have saved shareholders maybe $25 billion. But the fact that there was no negotiation is the issue, not whether a deal is a deal. It's that he's doing a deal with himself. I'd love to go to my company and negotiate my own pay package with myself. It would be great, and I'm a privately held company. But that's not the way companies work, and you and I both know that.
Now, again, Ross is acting like he sounds smart there, but if you do a private negotiation with yourself, and let's just say the private shareholders of the company overwhelmingly at the tune of 73% vote for it, and the assumption in the deal is that you 10x the value of Gerber, Kawasaki, and Associates, which given his ETF, that has not necessarily happened, Yeah, I think you deserve to get paid. And like that's the age-old debate here is like, if you made a contract, do you deserve to get paid? We've got Broadcom earnings after the bell. The bell's in 2 minutes. Or do you deserve to essentially bitch about all these technicalities and idiosyncratic things that happen in the process to making the agreement? At the end of the day, 70% of shareholders voted for it, and the guy 10x'd the stock. And it's still up 10x from 50 billion to 500 billion, even though it's fallen 50% from the highs in 2021. So I just think he deserves to get paid, and hopefully we'll see retail investors come through, and he ends up getting paid at the end. Daniel says this is an example of capitalism failing at its finest in America. Pay the man. Yeah, and it's also an example of people being just jealous. I feel like, and that lets you know that things are on the decline. When people are jealous of other people's success, that's not a good thing, in my opinion, for a society. You should want to be inspired by people's success and then do something you're on your own that hopefully makes you successful and hopefully allows other people to join your journey. But as soon as we start feeling resentment against it, it can end up leading to a really bad space just socially overall in a democracy. All right, it is 4 p.m. Wednesday, June 12th. Thank you, everybody, for being here. The stock market is now closed. You did not have to wake me up when September ended to tell me if today was a green day, because it was indeed a green day. Apple closes at 213, S&P 541.34, up 0.82% on the day. Walmart down a little bit on the day. Bitcoin 67,000, Bitcoin falling below 68,000. Rate cuts, or the potential of rate cuts, just not enough to get Bitcoin excited. Snowflake 130, that's up 1.44%. We'll watch that Snowflake video in a second. I've got it loaded up, so we'll watch that in a bit. Nvidia 125, up 3.5%. Opendoor up 4.46%. PayPal, unfortunately, could not find momentum. Again, I don't know what's going on with PayPal, but it's just the market is not excited about PayPal right now, down 2% on a relatively green day. CrowdStrike was green on the day. DNA was actually red on the day, green a little bit after hours, but it was down 2% on the day. Lyft was up today 6%, and Uber was up 5% on the day as well. SoFi ends the day up 1%. Broadcom earnings we should be getting in just a couple of minutes. Let's see what we get on Broadcom. Let me know in the chat if anyone owns this one. AVGO is the ticker. They are one of the core companies in the semiconductor ecosystem that is important. Market cap for Broadcom is, wow, 700 billion. I don't even know that. Okay, so $700 billion market cap. Let's look at their chart real quick. They're at all-time highs, basically. So they bottomed out in June. Well, I mean, I don't know if they bottomed out, but 1,300. Let's look at the 6 months. Okay, so they were at 1,000 to start the year. They're at 1,500 right now. So they've done pretty damn well. There were a ton of dips in between to get here, and now we're at all-time high. So this earnings has to go well to justify this all-time high, or maybe we see a little bit of a dip. Prakash, that's my largest holding. Wow. Okay, so we got some people that are into Broadcom. GOS sold Broadcom a couple weeks ago. I'm in long. Okay, so we got a bunch of people that's in Broadcom. ER is not out yet. That's correct. ER is not out yet for Broadcom. Let me pull up a couple of different things. So we'll look at Broadcom in a second. On top of that, Apple, where did Apple close on the day? Apple officially closes 213, 3.27 trillion. Market cap, Microsoft is 3.28. Wow. So Microsoft actually beats Apple by 0.1 on the market cap. Apple was ahead of Microsoft for just like 10 minutes, I guess. And then it came right back down. Okay, let's get an update here from CNBC, and then we'll get into Broadcom earnings as they are released in a couple minutes.
Take a little longer, but the process of getting to an anchored inflation expectation outcome and the Fed doing what they set out to do it's in train. And I think that's what he told you today. He was very positive on today's inflation print. He was very positive on the progress that's been made. And he's just telling you it's going to take a little longer. The bond market has to readjust the curve a little bit. We saw a few of the front month contracts in the interest rate futures not trade as well as the back months. But that's just, that's just a little bit of baloney slicing. It's nothing specific. The 10-year had a good response to the data and a decent response to Powell. And I think in general, it was almost like what Mike Santoli said at the end of in the lead into our segment. It's that the Fed can act if they need to. The Fed is there for you if you need it. And that's been a theme of ours all year. The Fed put structure is really back.
You guys called him Steve Aoki. That's hilarious. Okay, so we're about to get earnings in a second. We're looking at a revenue of $12.06 billion. That's what we're expecting. Semiconductor solutions, $7.19 billion. Infrastructure software, $4.95 billion. EPS of $10.85. Free cash flow, 5.1, and cash from operations of 5.6 billion. Adjusted EBITDA of 7 billion. So these are the numbers that we're looking at right here. Top line, 12.06 billion. EPS, 10.85. And if we can get there, it's going to be exciting. Celsius was down on the day. Yeah, I don't have any updates on Celsius. It was a really green day. Celsius ended down 6%. It looks like Celsius is just not being respected by the markets. I actually do know what happened with Celsius. Bank of America decreased their sales estimates from 430 to 385 million for next quarter. It was either Bank of America or it was another bank. But yeah, that was the reason Celsius probably went down, because they got a technical downgrade on the earnings expectations. And so that's why they got hit. So for next quarter, we're looking at 12.7 billion of revenue and EPS of 11.95. So if Broadcom can hit those numbers, then we're going to see some momentum. A stock split. I don't know if we get a stock split on Broadcom. That would be interesting. It's up a little bit after hours. I think we're getting some green candles. Let's see if we get the numbers. I mean, a stock split wouldn't be horrible. It's a $700 billion market cap. It wouldn't be the worst thing in the world. No numbers yet, but we're seeing some green right there. We're aiming for some green. It ended up 2% on the day. Again, market cap 693 billion. Yeah, it looks like the terminal knows what the numbers are. It's out. Okay, let me see. Numbers not updated yet on my end. It should be coming very soon. Let me check the website itself. Does it have it? Annual reports. Their website is so weird, dude. Their website's very interesting. Looks like a website from a... Yeah, it's not on the website yet. Let's see. Is the stock reacting? Oh, stock's up a little bit, up 0.8%, which is a lot for Broadcom. Going up 1% on a stock that high helps. Yeah, the numbers are not out anywhere. Does anyone have them? You guys don't? Yeah, no one sees them yet. They should be out soon. Broadcom earnings hasn't missed in 5 years. Really? Broadcom hasn't missed in 5 years? I didn't know that. All right, let's see what we get. Let me see if CNBC has it too. Let's see if they have it. They don't have it either. Okay, yeah, so we're still waiting. We're still waiting on this one. Yeah, no, not out yet. Is Broadcom a better play on ARM chips than NVIDIA? I have no idea, quite frankly. I think ARM is the most vital from my elementary understanding of it. But Broadcom is still a huge player in the semiconductor space. I mean, SMH, remember that ETF we looked at in the beginning of the year? If we bought it, I think we looked at it at like 210. Or no, we looked at it at like 185 or something. It's at 263. A freaking ETF is up as much as an individual stock, which is incredible, dude. Absolutely incredible. PayPal still green, or a little bit green after the bell. Broadcom still green, but no numbers yet. They're out. Okay, let me refresh. Let me see. They're not on the company's website. They're not on the company's website yet. Apparently, Broadcom has a dividend as well. Their dividend is 1.4%. Stock's not moving crazy yet. I don't own HIMS. I missed out on that one. I missed out on HIMS. Calls on glove companies since Amit started working out. Dude, that's hilarious. That's hilarious. Broadcom is great for wireless chips. Oh no, it's down. Well, it's not tanking. It's still up after hours. 0.5%. Why aren't these numbers out, dude? Why are these numbers? Yeah, no one has them, dude. Literally no one has them. Website doesn't have them. Twitter doesn't have them. No one has them. Broadcom. Marvell had a great finish today, though. MRVL. Jose was talking about that today on the market open. He said he liked that one. This one's down a little bit, 0.76% after hours. Broadcom is still up, but not up that much. Yeah, the numbers should be out. 405. Yeah, no one has them. This one's making us wait. Let me show you guys the website. The website doesn't have them either. The last update was May 6th. I love when these websites say to accept cookies. I wish they could like actually send me some cookies, dude, because I love cookies. I really like cookies. Dougie Fresh out. Dude, if you have the earnings, put it in the chat, Brody. Don't hold back the. I'm pretty sure you don't have them because no one has them. Dude, why is this one taking so long? This one's. Let me see if CNBC has it. This one's taking a minute. This one is taking a minute. Yeah, they still have the Steve Aoki on CNBC talking about stuff. Dude, this guy definitely looks like Steve Aoki. He definitely looks like. Yeah, they don't have it either. They don't fucking have it either. Okay, let me just go to them and we'll probably get it in a second. Here we go.
More than the S&P, around close to 2%, but a little less when I last checked. But things were moving around a lot right there at the close. Does this mean this relatively higher rate environment?
There you go, 1.6%.
1.6, yeah, it came down quite a bit there at the end. Less patience with small caps, with early stage companies. What are the implications for the IPO market here? Because a lot of smaller companies don't feel like this is a great market looking at the S&P. They're rather looking at, you know, some of these smaller tech companies, for example, that are having a rough go in the early innings.
100%. And the higher for longer narrative, we've got to be a little more vigilant on inflation, is not good news to that crowd. That's the crowd that is a little more levered to rates and is more levered to lower rates being beneficial. So that's not going to play particularly well. It's going to favor the Mag 7s and the rest a lot more when you think about it on a relative basis.
Dude, it's not just me. Everyone on Twitter is wondering where the hell are these earnings. Everyone's wondering where they are. I'm maybe they're a 410. Broadcom earnings, they begin at 5 p.m. So the earnings have to be out at least an hour before. It's usually not 30 minutes before. Yeah, no one knows where the earnings are. Everyone's confused. Everyone is confused. All right, so I guess 4:15. It comes out at 4:15. That's so annoying, dude. That's so annoying. Okay, I have the Snowflake video up, but I want to do Broadcom. But before we look at the Snowflake video, the Snowflake video is very interesting. So basically, I'll show it after Broadcom. But Jensen Huang joined the CEO of Snowflake on stage, and I walked away thinking one thing, which is that the only reason Jensen is really excited about Snowflake, in my opinion, is because Snowflake's building a large language model and they have to buy a shit ton of GPU compute. And like, that's what I got. Like, if you're a bull watching it, you're like, oh my God, Jensen, like everything he touches turns to gold. Amazing. If you're like looking at it logically, I'm like, wait a second. Snowflake is creating an Arctic LLM. Jensen's talking about why compute is needed to build LLMs. But in reality, does Snowflake need an LLM? Is their LLM going to be anything better than Gemini or GPT? The answer is no. We know the answer is no. So how is that going to drive additional revenue or sales? Where is the sort of AI application there that makes it happen? And so when I was watching the video, I was just confused. I was like, why are these guys talking together? Like, what's the point of him even talking with Jensen outside of Jensen selling them a crap ton of GPUs? So of course, Jensen's going to be on their stage because that's a big customer for them. But my question is, should they be a customer of NVIDIA? Should any software company be buying chips? I mean, they're not supposed to be, building models. They're supposed to be using those models to build out enterprise data solutions. And that's the part that I'm left confused about. So I guess we'll see. Don't you think they're training a foundation model for something specific? No way, dude. And maybe I'm dead wrong on that, but Snowflake doesn't need to create anything specific. They use customer data to then build out analytic tools. So I don't think any foundation model they could build would be so unique, because if they're ingesting customer data into those models, then like, what's the point of what do you need a foundational model for, right? They're not building Sora, like text to video or text to audio or something. They just need an LLM to be a computational form of infrastructure for the organizations to manage the data lakehouses, which is GPT or Gemini or Claude. There's like a billion of them, or Llama. So that's why I'm just so confused why they're building it. And I've tried to ask people why they think it's happening, and all the smart people I'm talking to are like, there's no reason for them to be building an LLM, which is hurting, obviously, their operating margins. But maybe I'm wrong here. We'll have to see. Okay, so in 2 minutes, we should get the Broadcom earnings, and we'll see what ends up happening here. They have access to customer data to train. Yeah, but like at the end of the day, you're just connecting that data to a model. You're not like, unless they're building a model that is so specific around how to deal with enterprise data, which, I mean, like, that doesn't make any sense. GPT does the job fine, right? It's like, yeah, I don't know how they were building a model that is uniquely built for enterprise data. So I don't understand that. But I know why Jensen loves them, because Jensen's getting a shit ton of money from them. So that makes sense. Yeah, Steve is going to be on. Oh, Steve is going to be on at 4:15, but we got to look at these earnings. Okay, so let's look at these earnings. Steve will be on at 4:20 then. Let's just see if these earnings come out. All right, the earnings should be out in like 30 seconds, and we should get the answers. They are probably building a model per industry. That's the dumbest thing ever, dude. You don't need to build a model for supply chain and for oil and for healthcare. Like that makes no sense to me. That's hard for me to imagine. Like, imagine a model built on oil supply chain data. I don't know, dude. That's a hard sell. That's a very hard sell for me to think of. I don't know. Maybe I'm wrong there, but I don't think that makes a lot of sense. Okay, it should be out in like 30 seconds. Especially because customers have such unique subsets of data that they're using, right? So I don't know if that's going to be the grand. And if that is, then maybe their Arctic LLM is what drives all the adoption. But I'm skeptical of that. It's going to be tough to see. All right, we got a little bit of a green candle here. What are we looking at? Oh, it's green. There you go. We're up 2%. It is green. We're up 2%. Are we going for 3%? We are up 3.4. We're at 4%. We're at 4.9. Uh-oh, baby. That's green. 5%, 6%. Holy crap, dude. Broadcom is moving. 7% on Broadcom. 7% after hours on Broadcom. There you go. 16 hundo, 1605, 1615, 8.3% on Broadcom. Looks like the market likes the numbers. Looks like the market likes the numbers. I don't have the numbers yet. Okay, here we go. Got the numbers. Revenue, 12.49 billion versus 12.01 billion. That's a beat. EPS 1096 versus 1084. That's a beat. They beat on revenue. They beat on EPS, up 8% after the bell. There you go. There you go. If you got Broadcom in the chat, wow, it's still going. It's trying to go for 10%, dude. It's trying to go for 10%. It just hit 9%. It's 10% would be psychological. Let's see if it gets to 10%. 1630 after the bell on Broadcom. It was at 49, ended on the day. So basically for the entire day, it's up almost 10.3% because it was up 2.36% on the day. Not bad at all. Not bad at all. There you go. Broadcom up 10% on the day. Let me get their actual numbers from their website. Okay, so here's the actual numbers. Congrats to the shareholders. Yeah, and again, this is important for the broader AI market to continue to go further if companies like Broadcom are doing well. Revenue's up 43% year over year. Wow. GAAP net income of 2.12 billion, which means, hold on, they have a 2.1 divided by 12.4. They have a 17% net income margin. That's incredible. Adjusted EBITDA 7.4 billion. 10-for-1 stock split. Wow. That's probably the main reason it's pumping. 10-for-1 stock split. So Broadcom will be trading at $161. Probably in a couple of weeks. There you go. July 15th. So in a month. 10-for-1 stock split on Broadcom. Broadcom's second quarter results were once again driven by AI demand and VMware. Revenue from our AI products was a record 3.1 billion during the quarter. Wow. 3.1 billion from AI products. I mean, you don't have to be wearing jeans and like Michael Jackson to know that they got 3.1 billion during the quarter off AI. Infrastructure software revenue accelerated as more enterprises adopted the VM software stack to build their own private clouds. We are raising our fiscal year 2024 guidance and consolidated revenue to 51 billion to 61% of revenue. I don't know how much of a revenue raise that is, but 51 billion seems like it's at least 5 or 6% up, which is important. Consolidated revenue grew 43% year over year to 12.5 billion. Today, we are announcing a 10-for-1 stock split of Broadcom's common stock to make ownership of Broadcom stock more accessible to investors and employees. There you go. That's what the market was looking for, and it seems like that's what the market got. They got the split, and the split is happening. I mean, that's what you needed. That's what you needed. Shout out to those who got Broadcom. Shout out to those who got Broadcom. That's a hell of a beat, dude. That's a hell of a beat. Where's the stock right now? Now it's up 8%. SMH should be up after hours, potentially. SMH is up 0.73%. Look at that, dude. Broadcom is enough to take SMH up 1% after hours. The semis play in 2024 has been the most goated play of the year. Like, if you bet on the semis, outside of Intel, if you bet on any semis, I mean, let's look at the semis charts right now. You've done well. TSM, Marvell, ARM, Lam Research, Broadcom, ASML, On Semiconductor, SMCI, AMD, NVIDIA. Now, if you got an SMCI 1200, yeah, it was not the best buy. But outside of Intel, I think pretty much every stock, obviously NVIDIA leading the way, has done amazing. AMD was at like 90 in the beginning of the year. If you got in at 225, that was a bit overvalued, but still at 160, just absolutely incredible. Taiwan Semi was up 6% on there, 4.3% of the day as well at 172. So Broadcom continuing the semis momentum, 8.6% on the year. I think crypto has been good this year based on when you got in. Some fintech plays like Robinhood have been good. The semis have been good. And obviously the Mag 7 have been relatively good besides Tesla. So this year has been a really good year for a variety of these companies. CNBC is talking about it right now. Okay, let's see what CNBC has to say. And then we'll go from there. All right, here we go.
Start with the earnings. EPS came in at $10.96 adjusted, higher than the street anticipated on revenues of $12.49 billion, also higher than what the street was anticipating. The company announcing a 10-for-1 stock split as commencing July 15th of this year. So that's some new news. They also said that they did have a record amount of AI revenue in the quarter at $3.1 billion, driven by AI demand specifically for their custom chips and networking, as well as VMware. Keep in mind that they did acquire VMware recently, so that plays a big role. And the other factor in this report is their fiscal year 2024 guidance was $50 billion, and now it's $51 billion. So gone up by $1 billion. So the stock split.
That's good. $1 billion raise, dude. To do another $1 billion. I mean, that's a hell of a thing to do.
That improvement in guidance, and we'll say the quarter beat also helped shares go almost 9% higher. Guys.
All right, Christina Partsinevelos, thank you.
Thanks.
Let's bring in Stacey Rascon of Bernstein Research to discuss. Stacey, stock shooting higher. It's up about 9-10% right now. It was already trading at a record. We got a beat and raise here, driven largely by AI, but also commentary about the strength of VMware. Your take?
Yeah, look, it looks really solid, right? And this is for a stock that's had a good run. But as Christina said, a nice solid beat and raise. They took up the margin guidance as well as the revenue guidance for the year. The AI numbers look really good. They said $3.1 billion in the quarter. Their prior guidance for the full year was $10 billion. So they're already on a run rate that suggests we're going to have upside to that number. Like the stock split, I think, is the icing on the cake. All the cool kids are doing that now. Looks really solid. Looks really solid.
Okay. I mean, we can talk about the core legacy business, but it.
All right, there you go. Congrats to those that bought Broadcom. I mean, that's just incredible. That's absolutely incredible. Broadcom just having a hell of a day. And it continues to show AI is not a joke. Oracle proved it. NVIDIA obviously proved it a couple weeks ago. And now Broadcom continuing to prove it. And again, even if you're not invested in these, if you're invested in the broader market, you need a catalyst to keep the market higher. Even if you're not in Apple, even if you're not in Broadcom, you want to see them do well. And if they do well, it just means that the broader market can continue to go higher. And there is liquidity there ready to buy up these stocks because they're performing and the market wants to allocate capital to those companies. Dell, you say, is the only bad AI play. And look, I know people say this because it went down from 180, but Dell for the year is still up 76%. It's just the problem in the markets is that people get in when it's very obvious, and then that's when it tends to sell off. I mean, if you told me Dell computers would be up 76%, I just wouldn't have believed you. So remember, the story on Dell is operating margins. Those operating margins go up over the next 2 quarters. This thing spikes back up. And that's what Bank of America believes as well. The only problem is they have all this server demand, but not enough margins to get that demand to translate to the net income, to the bottom line of the business. And that's why it's down at 130 from 180. But it's the same thing with Abercrombie and Fitch. They increased operating margins 7x and the stock is up 4x over the past year and a half. Maybe the same thing happens with Dell. Okay, so what we're going to do right here, I'm going to call Steve in 5 minutes, and Steve has a lot of things to talk about. So we're going to have a good discussion with Steve, but before that, I really have to pee. And I know Steve talks a lot, so there's no way I'm going to be able to pee in between. So I'm going to play this quick clip of Jensen at the Snowflake conference. It's about 2 minutes while I go pee. You guys can listen to it. Let me know what you think when we come back about how Jensen and Sridhar are reacting. And look, Snowflake's down 130. Maybe it is a buy the dip. I personally don't see the long-term thesis, but I definitely think a pop from 130 to 175 is very likely, if not going to happen, just given how oversold it is. So here's Jensen talking with the CEO of Snowflake. I'll be back in 2 minutes, and then we'll call Steve, and we'll have a lot of things to talk about with Steve. Here we go.
I want to say, you said earlier, Cortex AI has an amazing team. We've been working with Cortex AI. You have an amazing AI team. It is truly, truly world-class. I'm here in Taiwan because we're at the beginning of a new era in computing. And the AI infrastructure, the computing infrastructure of the world is really built here. And so I'm here to unite the ecosystem of all the companies, technology companies here, so that we can focus on creating the AI infrastructure for the new industrial revolution. And so it's been a crazy few days, and it's going to be a crazy week. Otherwise, I'd be there live with you.
Thank you, Jensen. Just to hear you speak about the next industrial revolution and the impact that it can have is amazing. Shifting gears just ever so slightly, I want to talk about our partnership and how we are supporting customers together. You know this, NVIDIA's industry-leading accelerated computing is game-changing for our customers. And it's also been game-changing for Snowflake's own AI research team as we develop Snowflake Arctic. Our team built Arctic in just 3 months for only a few $1 million on incredibly efficient NVIDIA GPUs. And the Snowflake NVIDIA engineering collaboration helped reduce training time and improve efficiency. These allowed us to build state-of-the-art models for our community and our customers. What do you think, Jensen, especially as one of the early launch partners for Arctic?
Yeah, this is really a great achievement. First of all, you said something earlier that's really important. The fact of the matter is AI requires very large scale computing, and we should do it as quickly, which translates directly to as cost effectively as possible. The less time that you have to rent the infrastructure, the lower the cost. The more iterations you could train your models, the sooner you can get to market. The technology is moving so fast. Time to market is everything. You could either be time to market with a groundbreaking new achievement, or you could be second to market that makes an incrementally better achievement. And so time to market is vitally important. Efficiency is vitally important. Cost is really important. And in every single case, the training time is vitally important. The work in getting training time performance down, of course, getting performance up and training time down has everything to do with the infrastructure, how it's managed, but a lot of it has to do with the training software, the entire stack that it takes to be able to train these incredibly large models across a very large number of processors. And so the achievement that we had is really terrific.
So again, and I've got to go deeper into this, but what I got from that is Jensen saying, hey, Snowflake, you want to train models. That means you need to buy our GPUs. So let's work together. And I'm just left wondering, and I'm either going to be right on this or wrong on this. I think there's no in between. Either Snowflake doesn't need to train models and it makes no sense as a software company, or training models is the smartest thing ever and their Arctic LLM is going to be increasing business dramatically. And I guess we'll find out over the coming months in terms of what they have to say and how they end up growing. All right, let's call Steve because he has a lot of stuff to say, a lot of stuff to talk about. And let's get him here. He literally sent me a spreadsheet. That's how much stuff he has to talk about. We will be talking about Tesla as well. Steve, hello.
Tesla?
You heard me say Tesla, didn't you?
I heard you say Tesla.
Okay, so we've got a lot to talk about, Steve. I tried to get you on camera, but you told us that you told me that you're too big time to get on camera now. So totally understand.
You got jokes. I like that.
You can only call in via audio. I get it. Yeah. But by the way, do you know I got a manicure and pedicure the other day?
Okay, just go on.
No, what's your reaction to me saying I got a manicure? But you didn't see my tweet about that? I got a manicure and pedicure.
I don't spend a lot of time on Twitter, and I'm going to pretend you didn't say that. Just go on.
Dude, okay. Do you we need to destigmatize men getting manicures and pedicures because my feet look fabulous, bro.
I'm not destigmatizing anything. I'm not stigmatizing anything. I'm just saying that I think it's a waste of my time.
Okay, that's how I felt for 26 years. And then I saw my feet the other day and I was like, you know what? I think I need to get a manicure pedicure. And dude, you know how you trade your little Pokemon cards? I might start trading my feet pictures because like
If you can make money on it, more power to you.
that's what I'm talking about. All right. So Steve, thank you for joining. We got a lot to talk about. A lot of topics. I'm going to leave the best for last, which is Tesla, because I know you sent me a whole spreadsheet. So we're going to talk deeper about that. I want to start off with something you and I had a phone call about last night, which is GameStop. GameStop has about $3 billion in cash they've raised. I did confirm they sold 120 million shares.
I confirmed it late last night after going through all the filings, which I wish they just put out a very clear statement. But
yeah, so 75 million shares yesterday, 45 million shares about a couple weeks ago.
Just over 3 billion.
Just over 3 billion. What is your raw reaction to them raising this money? And would you consider buying the stock at about $25 a share?
I don't know about at $25, but I'm certainly interested, but I'm probably interested for much different reasons than other people.
Okay, so what is, well, let me ask you this question. With the cash, what do you think they can do with it? I guess is the deeper question here.
So you know where I'm going to go with this, and people are going to think I'm nuts, but I'll take you down the rabbit hole again. I really think Ryan Cohen is going to open up the nation's largest trading card shop for TCG cards.
Okay. And
so here's why. Video games are dying. GameStop's quarterly revenue continues to decline. Annualized revenue continues to decline. In 2015, they generated about $9.3 billion in annualized revenue. That's down to $4.9 billion. The facts are that video games are going digital. The facts are that less people are driving to a store when they can just download it, especially with 6G routers on the market now and gigabit plus speeds on download. That's just the way the video game industry is going. If that's the way the video game industry is going, you're going to have less people trading and selling back video games on the secondhand market. So their whole normal business model is getting crushed week by week. They need to do something different. And they just started a couple of weeks ago purchasing PSA graded 8 and higher slabs of Pokemon cards. I think what they're doing is they're allocating an undisclosed amount of money to buy these cards, and they're going to transform a lot of their stores. They're going to have weekly tournaments. They're going to host their own regional tournaments. They're going to host conventions. And they already have the best real estate space because they're in every good mall in America.
So you think instead of getting rid of the real estate and liquidating those resources, they transform the real estate into something else?
I think they get rid of the underperforming real estate that is in less desirable markets, but I think they keep the real estate that's in your bigger malls and real estate that's in the strip malls that are anchored by grocery stores that have a lot of foot traffic. They'll probably get rid of 40% of the capital leases and a bunch of the stores. But I think they keep somewhat of a physical footprint and they transform it. Look, the bottom line is that Pokemon is the largest media franchise in history. That's a fact. I've showed you the numbers. Bigger than Mickey, bigger than Hello Kitty, bigger than Star Wars, bigger than any of the Marvel franchises. The trading card game is huge. And when you actually Google pictures from international tournaments or regional tournaments of this stuff, whether it's Pokemon or Magic the Gathering or Yu-Gi-Oh, thousands upon thousands upon thousands of people go to these things. You type in Collecticon and you look how big these conventions are for purchasing sealed product or graded slabs or raw cards. It is insanity how big these things are.
So let me ask you about the business itself. They raised $3 billion basically out of thin air. What do you think about the corporate governance on doing this? And was it genius? Was it bad?
It was the smartest thing they ever did.
Why?
I mean, you have a shareholder base that could care less about getting diluted. We're not going to get into why that is, but they don't care about being diluted. They're going to buy the shares regardless. I would have done the same thing. I would have raised the money too. If you have an appetite for it, it's the same way Tesla has diluted shareholders over the years to grow. If you have a retail base or a institutional base that's willing to buy the shares regardless, why wouldn't you issue new shares to raise capital rather than tap in the debt markets? This, they don't have to pay back and they're not paying interest on it.
Dude, but that's the most exciting. They, in the highest interest rates in the past 40 years, they came up with a free $3 billion by doing nothing.
For free.
For free. Literally for free. They got Roaring Kitty to do a live stream and they raised $3 billion.
For free. So you now have just over $4 billion in cold hard cash. I mean, look, if I was Ryan Cohen, okay, I would take $2 billion, I'd throw it in SGov or some ETF so I didn't have to deal with the actual paper, generate 5.1%, and it's a monthly dividend. I'd probably buy some Bitcoin just to make the shareholders happy, and who knows, whatever. Spend $500 million on that. You still have $1.5 billion. You keep $500 million just to pay the losses on GameStop operations because it's not profitable. And then you start transforming and you make a deal with the distributors. You transform your stores and you create a place where everybody buys their product from Pokemon to Magic the Gathering to Yu-Gi-Oh! And all those things.
Do you think, last question on this, do you think that Roaring Kitty and Ryan Cohen are collaborating somehow?
No comment. Can't prove it, so it doesn't matter what I've done.
But if you had a gun to your head and someone said, hey, do you think these guys are working together? What would you say?
I don't know what I can't prove.
I would say they're definitely working together. If I had a gun to my head, I would be like,
I don't know what I can't prove.
There's no way Roaring Kitty does all this shit if he doesn't know there's a way for him to get paid on the back end. That's my hypothetical analysis. Now, maybe he's just that good and he knew he's kind of like signaling to Ryan Cohen and Ryan Cohen signaling back to him based on the moves they're making without having to physically speak. But there's definitely something going on here, I would argue.
I mean, maybe he's just one of the greatest investors of our generation.
Well, here's the other thing real quick on this. So his E-Trade account is like 300 million, right? He lives in Massachusetts. Okay. Now, Massachusetts has the highest, not only one of the highest state taxes, but also one of the highest capital gains taxes in the state. So people said he made 50 million from the GameStop thing in 2021. That means for him to have 300 million right now to invest, he would have had to turn 50 million to, let's say, 650-ish million, because half of it he would have to pay in taxes just to have the 300 million that he's investing right now. Which means he would have had to double and triple his money over the past 3 years, which means he literally is, if he's not working with someone else, the greatest retail investor of all time.
I mean, if he put $25 million in YOLO into NVIDIA, he'd have more than that. So who knows?
Maybe he got the meta dip. Maybe he got the, who knows? But
maybe he got the meta dip. Maybe he made money on the meta dip and then sold and then put it in NVIDIA, and maybe he's the greatest investor of all time. I mean, is it improbable? Maybe. Is it impossible? Certainly not.
Well, the point is he has to, if no one gave him the 300 million, that's his 300 million. He has to have 300 million liquid. He had to make it off of the 50 million. So he had to 6x it, and he had to potentially 12x it in order to pay the taxes. So like somehow, some way he got this money, and
he could have bought options on NVIDIA. He could have bought options on Meta.
Well, the reason I'm bringing this up is because it means he has to be a really smart guy to do this. And maybe he knows what he's doing.
He has to be a really smart guy, and maybe he knows what he's doing.
I agree. By the way, for everyone making fun of how I say Massachusetts, I don't know how to say this word. It's been triggering since I was in kindergarten. The S and the H don't come out right from my mouth. I don't know what you guys want me to say, but that's how I say it. Okay? It's Massachusetts. That's just like you guys think I'm trolling. I can't say that word properly. It is what it is. It's just, it is what it is. Okay. Steven.
Yes.
I think it's time to talk about Tesla. So Kathy Wood puts out a statement. I'm going to share it on the screen right now. She says base case, or really her bear case, but her base case is 2,600, which is a 15x on Tesla in 5 years. What is your raw reaction to that?
I am a Tesla shareholder. So if it does that, I'll be very happy. I like to think that I understand numbers, and I like to think that I can read financial statements. I like to think that I understand halfway decently some of these things. I cannot get to where they are getting on this.
You don't understand how Tesla could be worth like 7 trillion in 5 years?
I mean, I'm having a hard time understanding. I was hoping you could help me understand. Because I
Okay,
certainly,
so I pulled up this spreadsheet that I made myself to try to get some better understanding of this. No, I'm just kidding. This is Steve's spreadsheet. So we're sharing it on the screen right now. Steve, what are we looking at and why do you think her valuation doesn't make sense?
I mean, take EBITDA out of it, okay? Just go on their free cash flow. So she's saying that on the bear case, Tesla is going to generate $853 billion in revenue.
Yep.
On the bull case, 1.35 trillion in revenue.
Correct.
Okay.
Correct.
She's saying they're going to have a 4.3% free cash flow margin.
Correct.
Okay. That means that in the bear case, Tesla will generate about $37 billion in free cash flow. And in the bull case, $55 billion in free cash flow. And she wants it to have a 7 or a $10 trillion market cap. I can't get there because Apple has a 3.3 trillion market cap and they're generating $101 billion in free cash flow, which is double Tesla's bull case from them. Yet they want Tesla to have a 3-time higher valuation.
Hold on, let me just repeat that. So Apple currently has a 100 billion free cash flow run rate, which is double of Tesla's projections in the bull case by 2029, and they have a $3.3 trillion market cap. Tesla wants them to have 50% less of the free cash flow, but 3x more the market cap, which is why this doesn't make sense to you.
And it's not just Apple. Alphabet, better known as Google, $69.11 billion in free cash flow. Their market cap's $2.2 billion. Microsoft, another $3.3 trillion market cap. I'm sorry, not billion, trillion for Alphabet, but Microsoft, 3.3 trillion market cap. They generate $70 billion in free cash flow. Like, there are companies that are generating more than $55 billion in free cash flow, and their valuations are not even $5 trillion. I'm having a very hard time getting there. And then in EBITDA margin, you're telling me that they're going to make $430 billion in EBITDA. They're going to make 4x or 3.5x what Apple's making right now. And they're going to have pretty much the same margin as Apple. I'm having a hard time believing this.
Why do you think she came up with this argument then, or this thesis?
No clue. No clue. I can't get there. And here's why I can't get there, because they don't even have bots as part of this. This is all from ride hailing and EVs.
So right here, we're looking on the screen.
Too much has to go right. Governments have to allow EVs to have full self-driving. Governments have to allow them to transport people that are not family members. Government is going to have to let them basically run wild. I think it's a lot to happen in 6 years or 5.5 years.
They're expecting 88% of the revenue to be robo-taxi, and they don't even factor in the bots. And one of the reasons you bought Tesla is because of the bots, right?
And yes, it's the main reason. And can we just be very clear on something? Uber generated $39 billion in revenue in the past 12 months. You put that together with Lyft and yellow taxi cabs and other things, I don't know how robo-taxis is going to generate what they're saying it's going to generate. It doesn't make sense to me.
Yeah, it's close to a couple $100 billion, which is basically half, 600 billion.
Look, as a shareholder, I welcome this. I hope that they are correct, and I hope that this plans out because I'll make a lot of money. Myself, I am having a hard time understanding the numbers.
So it's funny because her previous model she put out a couple of months ago said that Tesla will be $1,400 by 2025. 2025 is around the corner, and that's why they created a new model where they didn't include their 2025 price target. They included their 2029 price target. So they're buying more time to kind of get this thesis to play out. Do you think there's any chance that robo-taxis do become a monopoly and that Uber ends up dying? Like in the most bullish of my question is, in the most bullish of bullish scenarios, what do you think happens in the next 5 years?
So before I answer that, the taxi market is estimated to be quite large, reaching around 278 billion in 2024 from Modar Intelligence. Now, they are saying that experts predict it to grow to 432 billion by 2029 globally.
Wow.
Globally.
Wow.
They would have to get every dollar of what the projections are for how big the taxi market is. And that still doesn't even come near where they're projecting. And I don't know that the population grows enough to expand the total addressable market that much, but I'm having a hard time when Uber is making less than 40 billion a year. Even if Uber makes 100 billion a year in 2030, I mean, let's just say they take Uber out. Let's say robotaxi becomes the next thing. The taxi market's the industry is not that big today from what they're saying that Tesla's going to generate. So I'm having a very hard time with it.
It's a fair point. They would have to really expand the pie, the total pie, just to be able for Tesla to get the revenue.
I mean, they're basically saying nobody's going to buy cars and everybody's just going to use ride-hailing service instead of owning a car. And the owners of the cars are basically going to buy cars for a business opportunity. How's that any different than what Uber does? Except you don't have a human driver.
Yeah,
I mean,
no, you're that's a good point. Kathy's point is like cars are going to be eliminated or ownership of cars is gone. It's all rides. Your argument is that is Uber today. It's just not self-driving.
Yeah, it's Uber today. Even if Tesla cuts the price by 50%, I'm sorry, even if Tesla cuts the price by 50% because you don't have to pay the drivers, are rides really going to go that much up? And are people going to give up their cars to do that? Too many things have to go right for their projections to pan out.
Yeah, and
I like it's a sure thing.
I like having my car. Like, I enjoy driving my own car.
No, I told you, I will buy a Tesla or an EV the day that I'm allowed to sleep in the car. Until that happens, I'm not interested.
Wait, why can't you sleep in your car right now? What's the problem?
Well, I can if I'm not driving, but if I can't sleep while it's
okay.
driving,
Gotcha.
I'm just saying, like, until full self-driving is a real thing and it's regulated and you're actually allowed to use it and you get insurance to not drive your vehicle, I am not interested. And I think when you look at the amount of things that have to go right for robotaxis to be a thing, it's not just getting legislation, which is going to take forever, in my opinion anyway, but trying for the insurance companies to figure out how they're even going to create a product for this and then how they're going to price it and whatnot. I mean, that's not going to be easy. I'm not saying it can't be done, but there's a lot of things that has to be figured out in the marketplace for this to actually happen.
Yeah, and I want to remind people, Steve's not saying this is a Tesla bear. He owns Tesla. It's more so about...
I own Tesla. I want it to happen. And I'm not saying the ARC is wrong. I'm saying that it's very hard for me to understand how this is going to unfold in the next 5 to 6 years. If they had said 2040, I'd be like, yeah, sure, it's definitely possible. Because by 2040, there's a lot that can happen. But you're saying 6 years. I'm just saying a lot has to happen for robotaxis to unfold like that. And I'm not sure that enough people are going to give up their taxi market to the size it needs to be for the robotaxi segment to generate what Arch says it's going to generate.
Okay, let me ask you this question. We got a fun comment here from Ben. He says, no offense, Steve, you're a smart dude, but you're bullish on Pokemon cards and bearish on robotaxis. That's thinking from 1999. What would your response be to that?
Well, pretty sure I'm full.
Steve just got taken out.
Second thing.
Steve, say that again. You got taken out. Say that again from the beginning.
We mean I'm just saying that I'm pretty sure that I'm bullish on the idea of robotaxis and everything else Tesla's going to do. Otherwise, I wouldn't be a shareholder of Tesla. So I don't think it's necessarily fair for somebody to say that I'm bullish on Pokemon cards but not bullish on robotaxis. As a shareholder of Tesla, I got to be bullish on everything they do. But do some research. Sealed product in Pokemon cards has outpaced the S&P 500 consistently time and time again. So I don't know why people think that this is like some crazy idea. It's the truth. Not saying it's a better investment. I'm not saying to buy Pokemon cards. I'm just saying if you actually look at the statistical data and you look at how much every box, excluding the most recent set, because it takes roughly 3 to 5 years for everything to mature because it has to go out of print. Buying a sealed box of Pokemon cards every time a new one is released every 3 months has been a better investment, has appreciated more than the S&P.
Yeah, and I think it's a
That's
good
all I'm
point.
saying.
I think it's a good point because a lot of investors are always looking for alpha. And like when someone presents alpha and they have numbers behind the alpha, aka what you're showing with Pokemon cards, and then people just say it's stupid, it's like, well, then go buy the S&P then if you think it's stupid, right? Like you always need to look for different ideas.
And I'm not saying that it's a replacement. I'm not saying people should do it. It could go up in flames tomorrow. I'm just saying what has happened in the past is it has appreciated more than the S&P over time. That's all I'm saying.
Right.
I don't have a lot of money in it. I do have some money in it.
How did you vote your shares for Elon's compensation package?
Is it a horrible thing that I didn't?
Yes. Can you vote tonight, please? he needs these fucking votes.
I'm going to have to go through my email and try to figure out where I need to go do this.
Let me make it easy for you right now. All you have to do in your email is look up it's this I'll put it for everyone in the chat. It's no, you use Schwab, right? It's oh no, Robinhood's different. Okay, so if you have Robinhood, it's called
I'm sure I have an email somewhere and I'll just click the link.
Okay, well, I saw my dad at 30 shares today and I was like, holy crap, I should probably like vote his shares. But this is the website, guys. I'll put in the chat if you need to vote your Tesla shares. This is the website that tells you how to do it. Okay, so if you were when you vote, are you going to vote to give him the money or no?
Yeah, because without Elon, this is not something I'm interested in.
Do you think the vote goes through for him at the end of the day?
I don't know. I think it's getting a little hairy right now.
We know ARC's voting, Ron Barron's voting, Brad Gerstner's voting, but then you got the Norwegian people for some reason that are not voting. And so it's going to come down to retail, apparently. And so I guess it's up to you and me to get him paid.
If it comes down to retail, he's going to win. But it really depends on BlackRock and Vanguard votes. I mean, I don't know why you would vote no. I mean, if you're invested in Tesla, I would think it's in your best interest for Elon to care and Elon not be pissed off and Elon actually do everything he wants to do at Tesla. If this comes through as no, he's got other things he can do. He can go focus all this time on SpaceX or Neuralink or XAI or Boring Company or X. I mean, I don't know that you really want him taking more time away from Tesla than he already is.
Yeah. No, I agree. If he loses the vote, what do you think happens to the stock in the short term?
I don't even want to think about it.
Yeah, I think it's going to be bad. It's going to be ugly.
I think it's going to be really bad if that happens.
I agree. Okay.
I mean, if that happens, why would anybody want to stay in the stock if there's even a threat of him leaving or diverting more attention? I think there
have you thought of liquidating your position on the idea that he might leave? Has that pondered?
Of course, absolutely, because I don't know that anything is going to happen on the timeline that we have. I mean, look, he said on the last earnings call that they think they'll be able to sell robots at the end of next year.
Yeah.
I mean, really think about that. If he leaves, that now gets put into jeopardy.
Oh, it's not happening. There's nothing, dude. If he's gone, there's absolutely nothing. It becomes a car business trading at 64 times if he leaves.
If it becomes a car business with the prospects of Optimus significantly in jeopardy and the prospects of developing full self-driving in significant jeopardy, then how is it any different than Ford or GM? It has a renewable business that's not even that big.
It's not. Now, Steve, you're getting a little flack in the chat saying that, hey, man, if you feel so passionate about this, you need to vote. So we need to vote, Steve, tonight. You and me both.
Yes, I will vote my shares tonight. I forgot to do it.
Yeah, I forgot to do it today as well. And I just saw it and I was like, all right, it's time to vote. Someone just said, I just voted. I'm a 6-month stock old newbie, and now it's your turn. All right. So we will vote.
Yeah, I'll get it done tonight. I mean, look, I want this guy to be focused because I think Tesla has tremendous opportunity for everybody over the next 5 to 10 years. If Optimus comes out, I wish ARK would have done a prospectus based on Optimus. I could get behind that.
Me too. Me too.
I mean,
they
I
picked
just-
Robotaxi. They picked Robotaxi.
Why? I don't understand why everybody is so hell-bent on Robotaxi. It doesn't make sense to me. Like, there's too many things that have to go right for that to happen. They can start selling robots this year and next year. You know what I mean? There's no government regulations on robots.
Yeah, that's fair.
They could go sell robots to Amazon to work in the factories or companies to work on loading docks or whatever it is. There's no regulation right now on that. I mean, think about Tesla's factory. Tesla's factory is very automated. A lot of operations are automated. I mean, I think the robot industry has such a huge TAM ahead of it, and the headwinds from a regulatory environment are so much less than robotaxis that if I was putting that piece of research out, I would have built a whole case around Optimus. I would have kept robotaxis in there, but it would have been a very small thing.
All right, so let's transition to Apple. So I am looking at, in my room right now, I'm streaming off a MacBook Pro, paid $2,500. I have this iPad Pro that I barely use, paid $1,100. I bought my sister a MacBook Pro for her birthday. That was $1,800 in November. And I just bought these Beats headphones from which Apple owns Beats for like $200. I have a lot of Apple products. Stock was down 10% year to date. Now it's up 16% year to date. They
What
added
type of phone do you have?
Oh, and I have an iPhone. That's correct. And I have an iPhone. There you go. The stock has added close to $300 billion in market capitalization in less than 48 hours off the announcement of AI integrated into the Mac, iPhone, iPad, etc. My question to you is, do you think that surge in the stock in the past 2 days is justified given none of the growth has actually happened yet?
Guess what?
What?
The king is back.
Okay, explain. Why is this justified?
Because Apple did the smartest thing they could have done. They're never first, but they win at all costs. They weren't first with MP3 players, and they figured out how to make software and hardware work together with the iPad and the iTunes Store. They weren't first with computers or laptops, but they make a great product. They weren't first with the phone, and they basically own the phone market in the US. They weren't first with tablets, and guess what? They pretty much own the market in the US with tablets. They are a winner. Whatever they set their sight on, if they really want to do it, they win. You could make an argument they didn't win with the car business. It was something that they shouldn't have even gotten into, and I'm glad that they got rid of the project and they are reallocating those resources to AI. And guess what? It's not about them building some amazing AI thing. What they just did is they just created a 3 to 5 year mandatory upgrade cycle because the programs that are going to change people's lives haven't even been developed yet. They are creating a platform for everything to be developed on. You're going to have third-party companies build incredible apps. Apple's going to build incredible apps. They're going to embed AI into a ton of things. Siri will become a true personal assistant.
Steve, by the way, while you're talking, the stock is going up. I'm just letting you know that right now.
And you're going to need one of the new phones or one of the new tablets or one of the new computers to utilize everything. So it's not just an upgrade cycle on the iPhone. It's an upgrade cycle on the iPads and on the Macs. So instead of losing 2% on top line revenue and having to manufacture earnings by buybacks, you're now going to get probably 2 to 5% annualized growth on the top end and blow earnings out of the water because you're still going to do buybacks. So it's the best thing they could have done. It's truly remarkable.
It is remarkable. Stock's at an all-time high, PE of 33. I'm assuming you think they get to what, 7% growth next year? Right now they're at 0.
Yeah, I think 3 to 5% is
So
fair.
the
Low to
question
mid-single
here
digit.
is a unique question. Is it worth paying a 33 PE for 3 to 5% growth with 100 billion in buybacks, setting a floor to the stock? Does that make sense to you?
I mean, look, it's a company that gets bought every 2 weeks. I don't think people really put in perspective how much money goes into Microsoft, Apple, and now NVIDIA every 2 weeks. Every 2 weeks, there are millions of people who force buy stocks because they are taking money out of their income and putting it away pre-tax in 401k plans, 403b plans, SEP IRAs. A lot of them are putting it into S&P index funds, total market funds, or target date funds.
But Steve, besides that, just on the pure argument that 5% growth, is that worth eventually it'll be a 40 PE if it gets up to 230? Does that make sense?
Yeah, it's not just about the top line growth. It's about the EPS growth, and this could really make it a lot more EPS growth. And the new projections, when they come out, Apple could be trading at 26 times forward PE.
But my question, so you say increases EPS over top line, but the only way that happens is if margins go up. And do you think AI is going to create margin growth? Is that what you're saying?
Maybe it does. I mean, let's look at where Apple's trading for forward PE. Hold on. So they're trading at 26 times 2026 earnings. That's not that expensive. It's really not.
For 3% growth in 2026, you're saying?
I mean, their earnings growth is 7% this year, 9.5% next year, and 10.5% in 2026.
Okay, yeah, that's actually fair. That's actually fair. That makes sense.
I mean, it's and it's still a company that's going to continue to do a ton of buybacks. They have other levers they can pull. They are going to be buying back.
You wouldn't say that's
shares.
cheap, though, right? You wouldn't say that's expensive,
I'm not saying it's cheap.
Okay.
But I mean, look at Amazon. Amazon's never necessarily been cheap, and it's a great company that many people own. I just bought more of it.
Yeah, well, we'll talk about Amazon in a second because I want to get your thesis there. But okay, so what else did you hear from the AI event besides the upgrade cycle that you think? Okay, let me ask you this: the ChatGPT thing. Elon says he's going to ban phones from Tesla if they have ChatGPT. What do you make of that?
I mean, have fun with that. We're going to tell your employees they can't have an Apple product. That's not going to go over well.
You don't think he has any point here?
I don't know that it matters.
I mean, dude, at the end of the day, Sam Altman has access to 2 billion people's data. This is what I talked about last time you were on. You said it didn't matter, which I kind of agree with you. It doesn't matter, but to Elon, it does. I mean, do you think consumers will care over the next couple of years?
No, I don't think consumers will. Here's the thing. Does anybody read the terms and conditions when they check off the box, when they open up a computer, or they get an iPhone? Because if that answer is no, which it probably is, so I don't know anybody that actually reads it, why does this matter?
I think that's a fair point. Now, granted, if there's a data breach or something and OpenAI does some wacky stuff, then yeah, that's not going to be the best.
There's data breaches all the time.
Yeah.
That's nothing new.
That's fair. That's fair. I agree.
It's just the times we live in.
Okay, so Apple at one point today was higher in market cap than Microsoft at 3.37 versus 3.27. Do you personally think Apple should be a more valuable company than Microsoft?
I think it's difficult. I think by the numbers, Apple should get a little bit more of a multiple than Microsoft, but I think it's a race to $4 trillion. And I think NVIDIA may end up beating both of them to $4 trillion at this point.
Well, let's talk about NVIDIA. Someone told me that Stephen Fiorillo bought NVIDIA yesterday. Why did you initiate a position for the first time ever in NVIDIA?
Because I'm very late, but you know what? Sometimes it's better to be late than not at all. And I mean, I think people are just going to keep pushing it up. I've never seen any type of earnings growth like this. I mean, this is a phenomenon that when I look at the research, they're just going to sell more chips and they're just going to get bigger over the next couple of years. And I think a lot of people after the split are going to be buying it. I mean, look, I bought Amazon pre-split, right? So people were telling me I was nuts when I did that. But I was like, you got to look at percentage. It doesn't matter if you pay $10 or $100 for a stock. If it moves if you double your money, you double your money. 100% is 100%.
Yeah.
It doesn't matter what the share price is. You got to look at percentage gain. So I don't care if you pay $5,000 for a stock or 500 for a stock. If you double your money, you double your money. So I think looking at price is not necessarily the best idea, but for some reason, people have a much easier time psychologically paying $125 for a stock than $1,250 for a stock. So I think you're going to see people pile in. I think that this is going to get a lot more momentum because it's inexpensive. And I'm not saying inexpensive on earnings, I'm just saying inexpensive from a dollar amount to actually buy shares.
Do you feel, so I know you said about like when you buy it is whatever, but you are buying it at all-time highs. Is your argument that earnings simply are going to increase given the demand that it doesn't matter?
Yeah, I mean, if they keep going like this and they haven't even introduced the new series chip that seems like there's a huge backlog for, I mean, earnings can keep growing. I mean, when you look at what the analysts are projecting for earnings growth, if they're correct, yeah, this thing could keep going for years. So I don't know.
Yeah,
we'll see.
I agree. All right, last one. Amazon just put an article. I'm putting it in the chat. Everyone, please make sure to check it out and support Steve on this article on Seeking Alpha. So you're saying Amazon, which has kind of lagged the Mag 7 in terms of its growth rate year to date on the stock, you're saying it looks cheap historically. What is the argument for why?
Did you read the article?
I did not read the article, but I'm looking at the charts right here.
All right. So when I look at Amazon at the moment, I'm seeing a company that is trading at 41 times this year's earnings and 25.3 times 2026 earnings. This is the cheapest Amazon has traded since I've been a shareholder and before I was a shareholder.
Wow.
And Amazon's year-over-year growth on EPS is 56% this year, 26% next year, 29% in 2026, and 10 analysts have it at 20% growth in 2027. I mean, this isn't one person making a prediction. They're growing in double digits for the next 6-7 years, and not 10, 11% just getting over the double digits. They're growing at over 20% next year and in 2026 by the consensus estimates. Also, they're projected to generate over $1 trillion in revenue in 2029. If they come close in 2028, the consensus estimate's $957 billion. No company in the history of the U.S. stock market has ever generated $1 trillion in revenue. Think about what the news cycle is going to be when they start flirting with $1 trillion of annualized revenue. Really think about what that news cycle is going to be like and how crazy people are going to go for it. And you start looking at their free cash flow, how they've spent on CapEx and how they're still spending on CapEx and generating a ton of free cash flow. And their margins are now, this quarter was just over 10%. I mean, they've turned the corner. I mean, they were investing when people were scared to make CapEx investments, and they were spending so much money getting ahead of everybody. And if AI is what everybody thinks it's going to be, you're going to need more data centers. You're going to have more cloud offerings, and AWS is neck and neck with Azure. They're just going to keep getting bigger and bigger. I mean, I think Amazon could be the most interesting Mag 7 stock right now.
You think they're going to do you think they're going to do $1 trillion in revenue in how many years?
Well, I'm going off of what the analysts are saying. You have 57 analysts. This is one of the most covered stocks, by the way. 57 analysts are saying that next year they're going to generate $710 billion. You have access to Seeking Alpha, so everybody can say. So they're not just trying to remember what I'm saying. Just go to Amazon and go to earnings and go to earning estimates. Look at the EPS growth and look at the revenue growth underneath.
Okay, I'm here.
I mean, when you look at this revenue growth,
yeah, no, you're right.
In the next 6 years, they're going to break $1 trillion. And this is not just, like I said before, not just one analyst saying this. You got 8 analysts saying that they're going to do $1 trillion in 2029.
Okay, so if that's the case, where is the growth coming from? Is it coming from AWS or is it just like
Yeah,
retail?
look, a lot of it's coming from AWS. A lot of it's coming from North America segment. Amazon, I think, and I don't know this for sure, but I think they're the third largest advertiser now.
Yes.
I mean, I think they generated $11 billion of their revenue came from advertising last quarter.
Yep.
I mean, they're the third largest behind Meta and Alphabet at this point. So, I mean, that's something that can continue to grow. And I got news for you. I buy everything on Amazon. I needed something on Sunday. I placed an order at 11 a.m. or 12 around noon, give or take. I had it by 10 p.m. that night. I needed a new router system. Didn't have to go to the store. It was there to me in 8 hours.
I agree. I don't think it's I don't think Amazon's going anywhere. All right, last thing we'll do.
Unless it's food that's perishable or something like that. Like I use Amazon for a lot of things because why not? Why waste my time going to the computer store when I can have it delivered in less than 24 hours?
No, I agree. Dude, I get my deodorant.
Unless I need it on the moment. You know what I mean?
Yeah, I get my deodorant from Amazon. Like Amazon's it's not
Why not? Look, when I would argue that, and people are going to think this is crazy, but when the Black Friday sales come, things like toothpaste and deodorant stock up on because you're going to get it such a discount, put it in a closet. Mouthwash, that type of stuff that doesn't go bad. Toothbrushes, if you don't, I mean, it's just take advantage of it.
I recently got this water flosser thing, and because I saw so many videos about it on TikTok, it's actually pretty good at flossing. It's a cool gadget. Okay, Alibaba. Tell me why I should trust the CCP with my money.
Did you read the article?
You put out an article on Alibaba. How many articles you writing, bro? What is going on here?
Yeah, it came out yesterday. I sent it to you.
Okay, let me put it in the chat. Guys, here's the article.
I texted it to you and I tweeted it to you.
Steve, you text me a lot. Dude, for guys, before you guys say I'm a bad friend, Steve sends me like 17 Instagram reels a day. And
no, hold on a second.
Don't lie, Steve. Don't fucking lie right now.
I'm clarifying. On purpose, I send you every single thing that is interesting that comes in my feed about XRP.
So 17 things are interesting a day to you?
I want you to look into it. And I'm going to keep bombarding you with this until you look into it.
So you're admitting you send me 17 different Instagram reels a day.
I send you as much stuff on XRP as I see.
Oh my God, dude, this XRP nonsense. Dude, he's in a group chat with me and Chris. Every day he's like, hey, did you guys look at this? I think... Okay, hold on. I got to show everybody this. He sends me like 17 different things about XRP. I don't respond for 5 days. Then finally Steve's like, will you guys look into it? And I'm like, no. I'm like, no. And then he's like, why are you so scared? How about I buy you some XRP? And then you say all this stuff. Steve, it's not that I don't want to look at this. I'm just so busy. Dude, I'm just busy, bro. That like I have so many things to fucking do.
You're too busy to watch a video or listen to a video while you're running on the treadmill or something, or driving in a car to go get coffee.
Dude, I'm listening to a podcast about this girl with the cutest baby who's only 22, and she was talking about like how she managed her pregnancy. Like that's the stuff I listen to in the car, because like, you know, I like her on TikTok, and she did a podcast and stuff. Like, anyway, Alibaba. Why should we buy Baba?
Yes. Man, you talk about something that is undervalued. I mean, look, there's so much risk with Alibaba, and I get it. I am not saying that it is safe or secure or anything, and I don't have that much money in it, but I am in it, and I bought a little bit more recently, and, you know, this is a company that is the biggest cloud infrastructure play in China. The Chinese government is becoming more business friendly, if you can believe that. They're allocating tens of billions of dollars to chips. They're allocating tens of billions of dollars to real estate. They are allocating money everywhere. They're coming out with new framework to help secure their capital markets. They want to compete, okay? They want to overtake the U.S., quite frankly. And they know on some level they're not going to be able to do that being anti-business. Alibaba, when you look at the financials, you actually take a minute to look at this thing. It trades like a tobacco company. All right. It is trading at 9.5 times this year's earnings. It's trading at 7.5 times 2027 earnings. When you look at the balance sheet, if you believe the numbers, it's $79 billion in cash and cash equivalents on hand. They have another $59 billion in long-term investments. They only have $20 billion in long-term debt. You strip that away, they still have like 50% of their market cap in cash. That is on top of generating $130 billion in revenue and tens of billions in free cash flow. They just increased their buyback program. They are issuing a dividend now. Very hard to buy back shares and pay a dividend when you don't have cash.
That's true. That's true.
So that's the thing that makes me believe the numbers even more, because they are buying back shares and they are paying a dividend. So you're getting.
So when does the market switch? When does the sentiment change?
I don't know if the market's ever going to switch, to be honest with you. This could be dead money forever. Who knows?
But why are you buying
I just
it?
think that because I think there's a huge opportunity. That's why.
But you just said it's dead money.
I said it could be dead money forever.
So why not buy NVIDIA? Why buy this?
I did buy NVIDIA.
Yeah, but why not further?
I like being diversified. To me, this is a educated risk that I feel good about, that I think over the next couple of years could play out. I don't need it to do anything in the next 6 months. I think that things will blow over. I could be 100% wrong. This could get delisted, and I may need to wait months to get my shares on another exchange. I mean, that's the one thing I will say. If anybody's actually interested in this, call whatever broker you have and ask them what happens if Alibaba gets delisted, and make sure you're okay with what they said. I know what happens with my broker. I'm okay with how that scenario would play out. But from a pure numbers standpoint, this thing is so undervalued that it is crazy.
No, I agree. The undervaluation is insanity on Alibaba.
It's
just
insane. It's insane.
So if there's any risk that China stops being stupid, this thing goes up, is your point? Or like at least it has the potential to go higher.
Yeah, I mean, there's a lot of potential for this. They're the #1 cloud provider. They're the AWS of China. They're making AI strategic investments to boost their cloud offerings. Think of them as another Amazon.
Oh, you're right. That is fair.
So it may not do anything, but I'm buying some here and there because I think it is going to do something. I'll tell you though, the indirect winner in this whole AI thing is utility companies.
What, like energy?
Yeah, utility companies. NextEra, Southern Company, they're the indirect winner. There's over 2,000 data centers in the US. The amount of energy that these chips need to run is immense. The amount of data centers that are being built to actually house this stuff is immense. Utility companies are going to be the indirect winners.
Yeah.
Don't be surprised if you see a rally in utilities.
No, I think you're right. I mean, and everyone knows energy needs to be created. The information Steve did just reported, OpenAI did 3.4 billion in revenue, which is up 100% in the past 8 months. And so obviously the AI growth for them is exceptional. The energy is going to be needed to train those models.
Yeah, I mean, I think Chevron and Exxon are interesting. I think Southern Company and NextEra are interesting. And I think they're going to be the indirect winners in this whole AI thing.
Any thoughts real quick on Broadcom up 12% after hours?
I don't really follow them. I don't know.
Okay, yeah, they're an AI play. Or they're a semis play. And SoFi, someone wants to know any updated thoughts on this one.
No, I mean, the thoughts are still the same. I'm very bullish on them. I mean, until they give me forget stock price, until they give me a reason not to be bullish, there's no reason for me not to trust management. They've hit every mark that they've said they're going to hit. They got profitable. They're generating a ton of growth. And they put out a thesis for 2026. Let's see if they get there. I don't think that there's any reason to doubt them at this point.
Someone said, why will Chevron be a winner in your case?
Because they're producing cash hand over fist. Them and Exxon are the two largest producers of oil in the U.S. The U.S. is the #1 oil and gas producing nation in the world. We're producing oil at all-time highs, and the amount of oil and gas that we're going to need over the next couple of years is going to probably increase because the energy demand is going to increase.
Gotcha.
Now, if OPEC decides to flood the market and commodity prices fall, it may not be as great as what it is now, but they're still going to make money hand over fist. Some of these companies have break-even points on a barrel in the high 20s, low 30s. Oil's at 75 a barrel.
Right.
I mean, look at the amount of cash flow these companies have. It is crazy.
All right, last question, Steve. I was in California last week. I attended a conference.
Did you go to In-N-Out Burger?
I did. I didn't.
Was it good?
It was okay, dude. It wasn't like to die for or anything, you know.
Like, would you rather go to like a New Jersey or
Yes.
New York diner,
Dude,
or go to?
I'd rather go to Hansel and Griddle in New Brunswick, New Jersey, over fucking.
Like, I don't know what that is, but like I'm thinking like a good diner or something. Like, is it on par with a good diner?
Well, it's
Or-
cheap, dude. It was like $7-8 for a burger and some fries. The fries were disgusting, but like it is what it is. The cheese was barely melted, and the burger's not better than Five Guys, you know. So it's like it was okay. It wasn't amazing, but.
Okay.
But I was in California. I was at this conference.
Yep.
I ended up
Yep.
getting to host a bit of the halftime show at that conference.
A little conference.
Palantir's conference, actually.
Yeah, a little conference.
Did you do you have any updated thoughts?
Did I buy more in the past 2 weeks?
Yeah,
Damn
did you
right
see
I
did you see me on the halftime show and you were like, fuck it, I gotta buy some more Palantir?
I mean, I'd have to check the dates I bought, but I think I bought before the conference, not after the conference.
Any updated thoughts on that story, or just waiting to see it play out going into earnings as well?
I mean, I don't know how much more update I can get. I've been saying I think that they're going to be the second most important software company since you've known me, behind Microsoft. So, you know, I don't know how much more update I can get than that.
Yeah, no, I agree. And I'm going to make a video about this later today, guys, my takeaways from AIPCon. But I told you, I talked to many employees and the culture is just exceptional. It's just a different company.
Yeah, I mean, you know, when you actually listen to what their customers are saying, I don't see any of the, especially people should watch the segment with I think it was a senior VP from United.
Yes, that was the best one.
About how they use it for the maintenance and everything on the fly. I mean, do you see United ever changing away from Palantir at this point?
Nope.
No. They've completely overhauled their business based on Foundry and AI.
I agree.
And it's just, you really look at what their customers are saying, and I look at it as, man, I have gone through implementations of big software, and it is so difficult to even consider leaving and changing to something else because of how long it takes to implement, and then how your business is reliant on it, and what the cost to change is. I mean, especially when you get efficient from software and whatnot, I don't think people leave Palantir. And I think Palantir is ahead of so many people that the Oracle deal solidified it. I mean, it really did. Oracle can hire whoever they want. They can spend whatever they want. They can make whatever they want. They make one of the largest ERP systems for enterprise businesses, okay? They partnered with Palantir for AI solutions and cloud solutions. I mean, what does that tell you? And then look at indirectly, look what Oracle just reported about how much they've generated in contracts.
Yeah.
I think Palantir is probably going to get a sliver of that.
I agree. All right, Steve. Thank you for 55 minutes for joining. Let me put your not only your Seeking Alpha in the chat. Please make sure to follow them on Seeking Alpha, but your Twitter as well. And we'll talk to you again probably in a couple of weeks to get an update on everything.
Sounds good.
All right, Steve, we got to vote our shares. We got to get Elon paid.
I will vote my shares tonight.
All right. Thank you, Steve.
When is it's tomorrow, right?
Yeah, so we got to vote by 11:59 tonight.
Man, tomorrow, I don't know. This is gonna get hairy tomorrow.
I think he wins. I think 4 p.m. I'll be live. I think retail comes through and he gets it. So we'll see. We'll see.
All right. Talk to you later.
All right. Talk later, Steve. Thank you.
All right. Bye.
All right, guys. That is it for me. Thank you all for being here. Namir says he's definitely going to forget. Well, that's the other thing. I think JP Morgan or one of those guys put out a note saying that there's only going to be like 60% of shareholders that even show up for the vote. So I'm happy I remembered today. Everyone's got to vote, and at least if you want to vote. And I'm going to try to get my votes out there for Elon. For those asking, how do I vote? Here's the link. It's right here. This goes to Robinhood, but if you click on the link, it'll go to Schwab, Fidelity, whatever, and it'll tell you how to vote. All right, cool. So I think we'll have a video coming out in about 2 hours on my takeaways from AIPCon because I haven't done the recap video yet. So that'll be out probably like 7:30, 8 o'clock, maybe latest 8:30. So that'll be out today. And then tomorrow, 8:45 a.m. we'll be back. PPI tomorrow. That's going to be important. And then 4 p.m. we got Tesla's vote. And so we'll see what happens tomorrow at the market close. All right. That's it for me. Thank you, everybody. Appreciate it. Hope you guys enjoyed Broadcom. Phenomenal earnings. Congrats to shareholders. I'll see you guys tomorrow morning, 8:45 a.m. Bye, everyone. Have a good one.